Morning, Megan.
Good morning. Can you hear me all right?
Yep, audio and video sound good. You're good to go.
Thank you.
Good morning, Kathy.
Oh, maybe it's working now.
Yes, it is.
Did we
Audio and
have a
video sound good.
I think I got in a wormhole and it turned into Monday. I will never turn my computer off again. It doesn't work well when that happens. So we're back on a roll. Thank you, John.
Sure, no problem. Morning, John.
Good morning.
How are you doing today?
Oh, not bad. And yourself?
Not too bad. Your audio and video are good. You're good to go, sir.
All right, thank you.
Sure. Attention, last call for audio video check. Please turn on your video and raise your hand and I'll call on you.
McKissick, does everything look okay?
Yes, sir.
Thank
You're
you.
good to go. Good morning, Sean.
Good morning.
How are you doing today?
Excellent. Excellent. Thank you.
Your audio and video sound good. You're good to go, sir.
Thank you.
Sure. Morning, Tim.
Good morning, John.
How are you doing today?
Good, good. It's a beautiful day here in North Carolina.
That's good. That's good. Your audio and video look good. You're good to go, sir.
Thank you.
Sure.
All right, Joanne, if you would, give me the signal. Perfect. All right. We will start in just a moment. All right, good morning, everyone. It's 9 o'clock. Let's go on the record, please. Any preliminary matters for my consideration before we get started this morning? All right, hearing none, we are with the public staff and the cross-examination of the DOS Spanos panel. Public staff, y'all may proceed.
Good morning, Chair Mitchell. I have no additional questions for Mr. Spanos.
Good morning. This is Bill Grantmeyer, public staff. All my questions will be to Mr. Doss. And Mr. Doss, you probably don't have it in front of you, but on the E1 filed by Duke Energy Carolinas, item 34A, that is a list of the long-term debt or all the long-term debt on your filing on September 30, 2019. I'm going to ask you a few questions about that. I don't think you need it in front of you. It's just very general. But by my calculation, there was $8.8 billion listed of first mortgage bond taxable debt. Would you accept that subject to check?
I'd be willing to accept that subject to check. I do not have that exhibit in front of me right now.
Yes. And the total long-term debt listed less the leases was is $10.8 billion. Would you accept that subject to debt, subject to check?
Yes, subject to check if that's what it says.
And will you accept that the dividing 8.8 billion by 10.8 billion results in 81% of the long-term debt being first mortgage bonds? Would you accept that math?
I can accept the math. I don't have the exhibit in front of me to know the context of the exhibit. So I do, I accept the math. I just don't know the context. So that's all I can tell you from that.
Chair Mitchell, I would, if we're going to ask a number of questions on this exhibit, I understand Ms. Grantmeyer may want to do subject to check, but I'd like to see if Mr. Dawson get that exhibit in front of him.
All right, Mr. Grantmeyer.
I'm actually done.
All right, let's proceed then.
Chair Mitchell, I would refer everyone to public staff potential cross-examination exhibit number 79. And that is pages 2550 and 2551. Do you have that available, Mr. Doss?
If you give me just a minute, we're pulling that.
All right, Mr. Grantmeyer, just to ensure that we're all looking at the same document, would you describe it, please?
This is the ARO-related coal ash revenue requirements company versus public staff. It's a 2-page exhibit.
All right, thank you, sir. Let's go ahead and get the document marked.
We would request that this be identified as public staff DOS rebuttal cross-examination exhibit 1.
The document will be marked public staff DOS rebuttal cross-examination exhibit number 1.
Do you have that available, Mr. Doss?
I do have that available now. Yes, sir.
Now, you would agree that this is for Duke Energy Carolinas?
Yes, this is for Duke Energy Carolinas.
And the title is ARO-related coal ash revenue requirements company versus public staff?
Yes, that's what the exhibit says.
And right below it, it says summary for DEC includes differences due to imprudence, disallowances, and equitable sharing.
Yes, that's what it says.
And I'll represent to you that this was prepared by Mike Manis, Public Staff Director of Accounting. Will you accept that, subject to check?
I can accept that.
Now, have you looked at this exhibit before today?
No, I have not.
would you accept that this exhibit shows the difference between what the public staff says will be the annual revenue requirements and what would be the annual revenue requirements under the Duke 5-year amortization plus a return?
Well, I can kind of digest what I can right now from looking at the document. I see that it has a column for the public staff recommended revenue requirement. I see that. There's another column for the company proposed revenue requirement, and it does say including return on rate base and shows a difference.
And the last column over shows the cumulative difference. Is that correct?
Yes, that is what it shows.
And we'll come back to page 1, but on page 2, approximately during the middle of the page, this shows settled rate of return pre-tax. Do you see that?
I do see that.
And it basically uses the stipulation numbers. Would you agree 52% common equity?
It shows 52% common equity.
And 9.6 ROE?
That's what it shows.
And debt cost of 4.27 long-term debt?
Yes, that's what it shows.
And of course, those numbers would only apply to the Duke Energy Carolinas numbers because the public staff did not include any return in its calculations. Will you accept that?
Could you ask that again, please?
The return number 9.6 and the common equity ratio and the long-term debt really only applies to the Duke Energy Carolinas 5-year return. Would you accept that?
I recognize that 52%. I recognize the 9.6%. I don't know how those figures may have been included in any calculations from our rates team at Duke Energy Carolinas or how they might have been included in any calculations from the public staff.
Okay. Now, let's go back to page 1. It says the cumulative difference, the last column. And you see, as we go down 3, it's $244 million rounded. Would you agree with that?
Chair Mitchell, I might object. I realize that North Carolina is a wide open cross state, but I think we're getting far afield of what I believe Mr. Doss's testimony is about. These seems like questions that are for Jane McManus and not Mr. Doss. I'm wondering if this is the right witness for these questions.
All right, Mr. Grantmeyer, would you let me know where you're going with this line of questions?
I'm trying to establish, first of all, he's the director of property accounting. And we're trying to establish what the difference is between, and we're dealing with coal ash now. I'm trying to establish the difference between the public staff's coal ash position and the company's coal ash position and the impact on the ratepayers through the revenue requirement. He is an accountant, and this is simple math.
Well, it sort of makes my point, Chair Mitchell, that we have revenue requirement witnesses, which was Jane McManus, that could have been asked these questions. Should, in fact, Mr. Grantmeyer wanted to ask these questions. Just for efficiency, Mr. Doss's testimony is not focused on these areas. I realize that Mr. Grantmeyer may want to ask these questions, but they seem inappropriate for this witness.
All right, well, Mr. Grantmeyer, I would ask that you proceed. I'm going to allow the questions to proceed. Mr. Grantmeyer, please move efficiently. We recognize the witness's credentials and the witness will answer to the best of his abilities and will give his responses the way that they're due. Mr. Grantmeyer, please proceed.
Now, you see at the bottom of the difference column, at the bottom, it says total. The difference over time would be $168 million of revenue requirement greater for, based on Duke Energy Carolinas methodology.
That is what the schedule shows.
And I direct you to public staff potential cross-examination exhibit 80. And this is ARO-related coal ash revenue requirement differences compared to increased financing costs.
I have that exhibit in front of me.
And we would ask that this be identified as Public Staff DOS Rebuttal Cross-Examination Exhibit number 2.
All right, the document will be so marked.
And do you recognize the first column, column A, that lists the long-term debt issuances?
I see column A.
And the footnote says, will you accept subject to check that it's from the DEC corrected E1, item 38, line 14, filed on February 14, 2020?
I accept that, but again, I'm not familiar with this exhibit or the footnotes or really anything here.
Well, would you accept, just looking at it, the multiplication that 5 basis points based on that debt would come out to $500,000 a year in additional interest costs?
I accept.
Column C.
I accept that that is what this schedule shows.
And the total after 3 years of each of the 3 years would be $1.6 million. Would you accept that?
That is what the schedule shows.
Chair Mitchell, I just renew my objection for this exhibit and the same objection to both exhibits.
All right, your objection's overruled.
Now, with regard to moving down the page, this is the cumulative, column D, E, and F. And you see, don't you, after 3 years, the cumulative additional interest is 1.6 million under column D.
I see the 1.6 million.
And the cumulative revenue requirement difference, that is the savings, is 2.44 million.
You said 2.44. I see a 244.
Yeah, I'm sorry, 244 million. Yes.
That is what this schedule shows.
Now, going to the second page, if we could, would you read the top part, reduction of annual revenue requirement versus additional interest?
That's what I see at the top of page 2 on this schedule.
Now, would you accept that the column G is the revenue requirement difference that's really taken from column E on page 1?
I see that those are the same numbers from column E on page 1.
And that column H is also the same numbers as column D on page 1.
Yes, I see that.
And simple subtraction math, if we subtracted column H from column G, would you agree that that comes out to be column I?
That appears to be what the schedule is doing.
And would you accept if we added up after 3 years, the additional revenue requirement or the reduction in revenue requirement by the public staff's method would be $241 million?
I don't see $241 million.
Okay, it's not on the schedule, but adding in the 86 million, the 80 million, and 75 million, would you accept? I know this is Grantmeyer math, but it is what it is.
If you've added those numbers up and they come to that number, then I would accept that, subject to check. Have no understanding really of what those numbers mean or really the basis underlying the calculations.
Okay, now we're going to move to your testimony to make your attorneys happy. on page 3, Mr. Dawes, you state the public staff witness Panis incorrectly asserts Duke has chosen a rate-making treatment that accounts for coal ash costs as deferral of expenses that otherwise would be written off. You accept that? That's basically what you say?
I'm looking at page 3 of my testimony, and yes, those are the words that I have in my testimony. I'm not sure I caught that you quoted it exactly, but I see the.
Yeah, it's not an exact quote, it's a summary.
Okay.
And now, isn't it true that Duke Carolinas chose to petition for deferral of the coal ash costs?
Well, Duke Energy Carolinas chose to follow the direction of the commission. And the commission's order in 2003, I believe it was sub 723. It was the 2003 order related to AROs. The commission directed Duke Energy Carolinas to defer the impacts of the adoption of FAS 143 at the time, and to come back to the commission later to address it for rate-making purposes. So when you say chose, I prefer to think of it as an obligation. You know, we choose every day to follow the orders and directions of the commission, as well as the Financial Accounting Standards Board, in my profession, accounting, or the Federal Energy Regulatory Commission's Uniform System of Accounts. We choose to follow those guidelines every day. I prefer to think of that as an obligation as opposed to a choice. It's not really a practical choice.
Well, in 2003, Duke Carolinas petitioned the commission for approval to defer it. Isn't that correct?
Yes, in 2003, Duke Energy Carolinas did petition for approval for that.
Now, if these costs had not been deferred, wouldn't they not be written off to expense?
Could you be more specific about the costs you're referring to?
If the coal ash remediation costs had the ARO costs had not been deferred, isn't it true that they would have been written off to expense?
If they had not been deferred in accordance with the commission's orders, they would have been expensed.
Now, so therefore, if they had not been deferred and you had not had a rate case, then Duke Energy Carolinas would not have been able to recover these costs and rates. Isn't that true?
Well, I think what's true is that if you go back to 2003, we were directed to defer these costs for the accounting entries that were associated with the adoption of FAS 143 ARO accounting. And in that order, the commission recognized and the public staff supported, and the commission approved deferral of those impacts until they could be considered in a future rate proceeding.
Now, would you agree that the use of ARO accounting under GAAP and ASC 410 is for financial reporting purposes?
Well, it's for financial reporting purposes and for the recording of the impacts on Duke Energy Carolinas books.
And would you agree that accounting for all retail rate making can differ from GAAP accounting, which is for financial reporting purposes?
Well, to be clear on that, when you say it can differ from GAAP accounting, our books and records are fully in compliance with GAAP accounting. So GAAP accounting actually recognizes that there can be overlays to GAAP accounting to recognize that there are impacts of rate making on the books and records. So when you say that, I want to be careful to make it clear that Duke Energy's books and records are completely in compliance with generally accepted accounting principles.
Now, isn't the difference that can be reconciled by deferring costs to a regulatory asset for rate-making purposes?
I'm sorry, could you give me that question one more time, please?
Isn't the difference between GAAP and rate-making accounting can be reconciled by deferring the cost to a regulatory asset for rate-making purposes? Isn't that what you've done here, is ask for deferral to a regulatory asset for rate-making purposes?
And when you say what we've done here, where is here?
Well, you've applied for a deferral, correct?
In which case are you talking about? Or,
Haven't you? Isn't the case in front of us a deferral to the coal ash costs?
well, I think the case in front of us is for the recovery of a previously authorized deferral.
Now, isn't it true under ARO accounting, only costs from normal operations are included, not costs for improper operations?
I'm sorry, Mr. Grantmeyer, could you repeat that one more time, please?
Under ARO accounting, isn't it true that only costs from normal operations are included, not costs for improper operations?
That is, I think, an accurate summary of the regulations under ARO accounting.
And isn't that why the costs of the remediation of the Dan River spill are not part of the ARO costs?
That's accurate, yes.
And what about the extraction well and treatment costs at Bluey's Creek, where there was groundwater exceedances, violations? Wouldn't that be excluded from ARO accounting costs?
I'm not familiar with that one offhand.
Excuse me, I'm moving on here. Now, isn't it that correct that in the absence of the commission approving deferral of the ARO costs, those costs already would have been written off to expense?
And which approval are you speaking of, please?
The approval of the ARO costs, ARC costs, in this case, ARO costs in this case, I'm sorry.
I want to be clear. I understand which costs you're talking about. You're talking about the costs for the period from January 18 through January 2020.
Yes.
And those costs, to be clear, those were approved for deferral treatment in the last case. And if for some reason the commission were to decide that they were not, prudently or reasonably incurred by the company and they were to be disallowed, those would be expensed.
And they would have been written off if they've been expensed, it's passed, correct? You would not have recovered it in rates.
Absent the commission's directives to defer those costs, they would have been written off.
Isn't it true that FASB and FERC standards require the recording of ARC costs in the property, plant, and equipment account?
That is correct.
And that doesn't necessarily mean that the property is used and useful for rate making purposes, does it?
Well, in my testimony, it's my position. I believe that they are used and useful.
But just because FASB and FERC standards require it in property accounts, for rate making purposes, the commission in North Carolina is not bound in any way that that's used and useful. Would you agree to that?
I would object to the extent, Commissioner, Chair Mitchell, to the extent that's asking for a legal conclusion. If he's just asking Mr. Doss's position on using useful as a non-lawyer, then it's fine. But I assume the question was asking legally.
All right, Mr. Marzo, we recognize the witness is not an attorney. I'll allow the question to proceed. We'll give it the weight. We'll give his response the weight that it's due.
Mr. Grantmeyer, I'm sorry, could you ask the question again, please?
Would you agree that although FASB and FERC standards require the recording of ARC costs in property, plant, and equipment, that the commission is not bound by that as far as being property used and useful for rate making purposes?
Well, I am not an attorney, so I don't know what the commission is bound by. It's my opinion that those costs are useful, and I might add that in our previous Duke Energy Progress case, as well as the previous Duke Energy Carolinas case, I believe the commission agreed that those costs were used and useful.
And when Duke created the ARC on its books, did you record only the amount of costs expended to date, or did you include estimated future costs of coal ash closure?
In compliance with the FERC and GAP requirements, we're required to record the full estimate of the future costs.
But you would agree that estimated future costs are not presently used and useful, are they?
Those costs, when they're initially recorded, essentially a non-cash entry when it's initially recorded. And again, used and useful is not a definition that's in the accounting books and records. It's a legal definition, so I don't know how to define it that way, but I'm describing the way the accounting works and the way the entries work when we do record those amounts initially.
Now, I'm going to read a statement for you, and I'm going to break it down. It's sentence by sentence. It's a direct quote. Would you agree that generally regulators ignore ASC 410 for rate making purposes?
I don't know about generally. I know that, I'm familiar with this commission's 2003 order and how they wanted us to defer those impacts.
Now, I refer you to pages 18 and 20 of your testimony, and I'll paraphrase it. You say that the Savoy letter and the Duke petition put the parties on notice about ARO accounting, and the public staff did not object. Does that basically summarize what you say there?
I think that's a fair summary.
Now, isn't it accurate to say that the public staff supported deferral only on the condition that rate recovery would be preserved as an issue for the rate case?
Mr. Doss, you're on mute.
Sorry. I don't recall the public staff's exact words.
But you would agree that they did not agree that it would be in rate base. Is that correct?
I'm sorry, could you repeat that question one more time?
Would you agree the public staff did not agree or accept that the ARO costs should be in rate base?
I'm trying to recall what the public staff's position was on that. And again, rate base is not an accounting term. It's not an account that I record to. So as the accountant, I'm not exactly sure what their position as far as how it should be treated for rate base purposes.
Now, would you agree that Duke's own petition then specified that rate making treatment of the deferred costs would be reserved for subsequent rate cases?
I think that's accurate.
Excuse me, let me see if I have any more questions. And you testified earlier the terms used and useful. You would agree, would you not, or are you aware that that's a statutory term under GS 62-133?
I am aware that it is a statutory term.
And used and useful does not apply to operating expenses. Would you agree to that?
I don't know if that's the case. I know that it applies to property.
Now, with regard to coal ash costs such as dewatering ash, excavating ash from impoundments, and transporting it by truck to a rail or third-party landfills, in your opinion, are those costs in the nature of operating expenses, or are they in the nature of utility plant?
Well, for the accountants, we follow, as I've stated before, I mean, we follow the guidelines that are provided in GAAP and in FERC. And those guidelines, if we've determined these costs qualify for ARO accounting treatment, it's very clear that they're capital costs.
For financial reporting purposes, isn't that correct? They're capital costs for, you're saying, for financial reporting purposes.
That's correct. Under both GAAP and FERC, it's very clearly identified as a capital cost to be recorded as part of the property, plant, and equipment to the asset that gave rise to the obligation.
Now, are you aware that under Commission Rule R8-27A1, that the Commission's orders really supersede FERC's uniform system of accounts for retail jurisdictional purposes? Are you aware of that?
I'm somewhat familiar with that. But it sounds familiar. It sounds like a legal type question, maybe, but I'm familiar with that rule.
Chair Mitchell, I have no further questions.
All right, thank you, Mr. Grantmeyer. Attorney General's office.
Good morning, Mr. Doss and Mr. Spanos. My name is Margaret Force. I'm with the Attorney General's office. I'm going to try to leave my microphone on active, but if we have problems, I'll start switching on and off. Most of my questions are going to be for you, Mr. Doss, and I'd like to follow up first on a couple of things that you talked to Mr. Grantmeyer about. All of my questions have to do with the coal ash cost recovery. You were talking first about, when you were talking about used and useful, I want to see if we can clarify, when we're talking about the asset retirement obligation having to do with the closure of the ash ponds and disposal of the CCR, the coal combustion residuals, that's distinguished from some of the costs that Duke incurred to convert to dry ash handling and to take care of water treatment at the various plants. Am I right about that?
I think that's an accurate summary.
And so for accounting purposes, when Ms. McManus talked about ARO versus non-ARO. When we're talking about the ARO costs, we're talking about the ones that had to do with closure of those ponds and disposal of the CCR, right?
That's correct.
Okay. And am I right that then the closure of those ponds is at the end of the use of those ponds, and that at many of those plants, the plants that generated electricity using that coal ash over many decades are no longer in use?
Some of the plants are no longer in use, some are in use.
Okay, fair enough. And you talked about costs that are disallowed if the commission disallows costs, but and you also mentioned prudence, but there are many costs that the commission examines to determine whether they're appropriate to include in a test period, whether they're prudent or not. Would you agree with me? Like whether they're normalized and how they attribute to the service that's provided in North Carolina versus other jurisdictions, and a number of different ways that costs may be categorized before they're included.
I certainly would agree generally that the commission, public staff, and others are reviewing the costs for reasonableness and prudence.
And reasonableness is not exclusively prudence then. Would you agree?
I've seen it, in the statutes, reasonable and prudent costs. So
okay.
that there's probably a difference perhaps between the two, yes.
Okay. Now, you've described in your testimony on a number of pages the GAAP and FERC and other accounting treatment used by the North Carolina Utilities Commission and how that relates to how it's recorded on in the records for Duke Carolinas, right?
Correct.
And we've had some questions in the case about how costs are accounted for under ARO accounting versus accounting that might be cost of removal or depreciation. And I'd like to walk through some of the history of that with you. And first of all, just to clarify, when we're talking about an asset, a legal asset retirement obligation, it's a legal obligation associated with long-lived tangible assets that are reported on financial statements. Does that sound like a fair description?
It's associated with long-lived tangible assets. That's correct, that are being retired.
And there can also be non-legal retirement obligations that are used in rate making for depreciation and cost of removal. Is that right?
Yes, that's correct.
Okay. But I think you've said, and maybe I think I understood it correctly, that they shouldn't be double counted. You shouldn't count them both ways.
I don't think they should be double counted.
Okay. Duke filed a petition that you've talked to, about a little bit in your responses to Mr. Grantmeyer. And it was a petition for an accounting order prior to the last Duke rate case. And that, I'd ask you to turn to that petition itself, and it's been admitted as AGO McManus-Spiros Cross Exhibit 1. It's also, if it's easier to find, in the exhibits that the AGO submitted at number 43. Those are probable cross exhibits.
I'm sorry, I do have that exhibit.
So if you have the AGO probable cross exhibits, it was number 43. Do you have that?
I do have that, yes.
Okay, if you look at it, would you agree with me that that's the petition that Duke filed for Duke Energy Progress and Duke Energy Carolinas on December 30th, 2016?
Yes.
Okay. And that was to request approval to defer all costs relating to the obligation to close ash basins and remove CCR, right?
Correct.
And that included a request for deferral by Duke Carolinas of a total of $2.1 billion estimated for the ARO. Is that right? I'll refer you paragraph 11 on page 9, if you're not sure. Is that right?
Yes, I see that number.
Okay.
Yes, I do.
Okay, that's gone up some since then, the estimate. Would you agree with me?
I think that's probably right.
And the petition also sought permission to defer the actual expenditures of $424.4 million made between January 1st, 2015 and November 30th, 2016, correct? That's paragraph 13. Is that right?
Yes, I see 430. I see the 434.4 million that you quoted. Yes.
Or did you say 434? I've got it wrong in mine. It's okay.
434.4 million.
Okay. I have a typo in my notes. Okay. The petition indicates that the commission issued an order in 2003, and you've referred to that in your conversation with Mr. Grantmeyer, and that 2003 order authorized the deferral of the ARO related amounts, right? And it says that in footnote 2 in the petition.
Yes, footnote 2 in the petition.
Okay. I'd like to look at that 2003 order with you, please. And I don't know how you have them in your notes, but that was AGO Exhibit 40. That was a potential cross-examination exhibit, and it's already been admitted as AGO McManus Sparrow's cross-exhibit 2. You see that? Are you there?
I do see that. Yes, I have that.
Okay, good. If you look at page 1 toward the bottom, it says that Duke indicated at that time that the only significant ARO at the time was to decommission radiated portions of nuclear plants and environmental cleanup at Blues Creek, but others may exist, right?
I'm sorry. Are you on AGO Exhibit 40?
Yes, and that's that document. Are you looking at what's captioned? Well, the order granting motion for reconsideration and allowing deferral of costs.
Yes, I am. I'm sorry. What portion of that page were you?
Sure, I didn't give you good directions. If you look down, there's background in the second paragraph. Toward the end of that paragraph, I have paraphrased. I didn't read it, but it says that Duke but I'm saying that the indication from Duke was that the only significant ARO at the time that this was being considered was to decommission radiated portions of nuclear plants and environmental cleanup at Blues Creek, but that others may exist, right?
Yes, that's what's included in it.
Okay, and then on page 2, in the first full paragraph, if you turn with me, it says that when an ARO liability is recorded, a corresponding asset is recorded on the firm's books as part of the associated tangible asset and depreciated over the life of the associated long-lived asset. It says that, right?
Correct.
And that sounds like the principle that you referred to in your testimony on page 10, where you describe FERC accounting and say that asset retirement costs are to be depreciated over the useful life of the related asset. Right?
Yes, that's consistent with that.
Okay. So if you turn then to page 4, and there's a paragraph there that starts, finally, Duke commented that. And if you look down to the second sentence, it says that it indicates that Duke gave some examples of non-legal asset retirement obligations. And those include removal of, costs of removal of distribution, transmission, and non-nuclear generation facilities, correct?
Yes.
All right. So let's turn to page 10. At the bottom of the page. and over onto page 11. And reading from that last incomplete paragraph there, would you agree with me? It says depreciation expense. I don't know. Okay. Depreciation expense, which in part is a function of depreciation rates, was included as a component of the company's North Carolina retail cost of service established in the context of the company's last general rate proceeding. Consequently, the recovery of that expense, which includes the cost of removal, is now provided for in the rates and charges Duke is authorized to charge for its sales of service with respect to North Carolina retail operations. Consistent with the economic consequences of that regulatory treatment, the cost of removal is accrued and recognized as an operating revenue deduction over the useful life of the related assets, rather than waiting to record the expense until the assets are actually removed and the related costs actually paid. Is that what it says? Did I put that correctly?
Yes, that's what it says.
Okay, so there's a third point that there's several points here, but there's another point that indicates the intent of the 2003 order was that any change in accounting would need to be submitted for approval and addressed in a general rate case or other appropriate proceeding before implementation. Would you agree with me?
I'm reading this and that any change in the accounting for cost of removal specifically. Is that what you're reading from?
If you, sure, and if you look at the next paragraph, the last sentence, does it not say, the commission is of the opinion and so concludes that the company should be and is hereby explicitly placed on notice that any proposed changes in the cost of removal for long-lived assets and or in the accounting of such costs must be submitted to the commission for its approval in the context of a general rate case or other appropriate proceeding prior to implementation, right?
Yes, that's correct. I'm sorry. When you summarized it a minute ago, I thought you were not specific to cost of removal. That sentence appears to me to be very specific about the cost of removal. Sure.
Okay. And I want to go back to the first part of that quote that we just started with on page 10. It says that the cost of removal was included in the company's last general rate case. Does it not say that?
It does say that, yes, here in 2003.
Right.
At the whatever rate case or rates were in effect as of 2003. I think that's what it's would have been referring to.
Okay, and actually that's where I was going. This was in 2003. Would you agree with me that the last rate case in North Carolina as of 2003 had actually been filed by Duke in E7 sub 408 in 1986? That was a case that was appealed and remanded and appealed and remanded, and all issues were finally resolved in 1992, but the rate case was actually filed in 1986. Do you have any reason to disagree with that?
I'm not sure about that docket that you're referring to and the dates. I just don't have knowledge of it.
But, okay. Well, I can ask the commission. I don't have all the specifics before me. I'll ask the commission to take judicial notice. But the next time that a general rate proceeding occurred was 20 years later in 2007. Were you working for Duke at that point?
I was working for the company at that point.
And that was actually not a request for an increase filed by Duke. It was an investigation, and the docket was E7 sub 828, and rates were actually decreased after that 20-year period. The rates were decreased about $200 million per year. Would you agree with that, subject to check?
Take that subject to check. I wasn't in my current role, and at that point, I was not involved in rate cases in 2007.
Okay. Since that time, there were 3 rate cases, one in 2009, another in 2011, another in 2013, and they were all relating primarily to the construction of the new Cliffside coal unit. Are you familiar with those cases?
A little bit familiar with those cases. Again, I was in a different role at that time and didn't have a lot of involvement with the cases.
Okay. And there was some controversy. Do you know anything when the certificate was issued for Cliffside? There was some controversy about constructing a new coal unit. But in any event, it was built, and some of the coal units were going to be taken out of service at that point. Is that within your recollection or no?
Sorry, I don't know that history.
Okay, well, during all of those rate cases, Duke did not, in those rate cases, seek to include an additional amount related to the coal ash pond closure or the disposal of CCR. Isn't that right?
I think John Spanos, witness John Spanos, would be better equipped to answer that question.
I think, Mr. Spanos, you were involved in some of those cases anyway. Did you? I think you testified last time that you were not asked to look at that cost. Am I right?
Well, yes, and good morning.
Morning.
In each of those instances, we reviewed what were known and measurable costs, and they were to be included. Anything that we knew and was measurable was included as based on the standards related to regulatory rate making purposes. So you are talking about some cases that had multiple factors in place related to why depreciation was either increased or decreased. Not all of them related to one specific component, but all of those we did review the depreciation studies and the analysis that was in place and what was to be most appropriately recovered in the depreciation expense for regulatory rate making purposes.
And my recollection is that I asked a question in the last rate case of you, and you indicated that you were not asked to look at the specifics of what might be involved in coal ash closures. Is that what you remember, or don't you remember?
No, I do remember. I was not asked to include coal ash closure costs in the calculation because it was going to be an ARO. So it would not be part of regulatory rate making calculation. So the discussion was not, that I remember that we had, was not necessarily whether we talked about it. It was whether they were known or whether they were too speculative to include in the calculation for depreciation expense.
Okay, so in fact, Duke indicated in the last rate case in discovery that it was assumed in the last dismantlement study before CAMA that the salvage value would offset the cost of dismantlement. And that's why it was a zero amount as far as coal ash closure. Does that sound right to you? Do you remember seeing that? It's already an exhibit in evidence if you're not familiar with it. Okay.
I remember seeing the discussion and the response. The decommissioning component that was included in the study was not related to the coal ash discussions, and I would not consider the fact that for decommissioning of the other assets within the calculation that they would have netted to, the salvage would net to cost of removal, if that's what you're asking.
Could you say that again? I didn't understand your response.
Yeah. If your question is whether the decommissioning study was supporting a net zero effect of salvage from cost removal for non-coal ash. That's not what the decommissioning studies show.
For non-coal ash?
That's right.
Okay.
And so I'm not sure that that's what you asked me in the last case or what you are referring to in this particular data request, but it sounds as though that was what the question was, and that's why I answered in the fashion that I did.
Sure, and the discovery request and response speak for itself. So I won't ask you to try to remember what it was. So on this point of quantifying the cost of removal, I'd ask, well, both of you can turn to it, but I was going to ask Mr. Doss to please turn to AGO Potential Cross Exhibit 29. And just for your purpose of identifying it, that's an EPRI document that's titled Decommissioning Handbook for Coal-Fired Power Plants.
I have that in front of me.
Chair Mitchell, I would ask that this be marked as AGO DOS Spanos Cross Exhibit 1, please.
All right, Ms. Force, we will mark the document AGO DOS Spanos Rebuttal Cross-Examination Exhibit 1.
Okay, and you're familiar with EPRI, I assume, and are you familiar with this handbook? Maybe you're not there yet, Mr. Doss?
Yeah, I'm sorry. Yeah, I was just making sure you were directing that question to me. I'm familiar with EPRI. I have not seen this handbook.
Okay, if just for purposes of the record, on page 2, the report indicates that it was dated in November of 2004, right?
I do see that date noted on page 2.
And if you would turn, please, to page 2-5, in the third paragraph, under the heading, solid waste landfills can be a major expense item in decommissioning. I'm just going to quote a sentence from there. Tell me if I've got it right, please. Are you there?
You're on page 2-5, is that correct?
That's right. And there's the second paragraph under that heading, solid waste landfills can be a major expense item in decommissioning. You see that? The first sentence in the second paragraph refers not just to solid waste landfills, but other impoundments. It says closure of surface impoundments and landfills probably will be the most expensive tasks undertaken during a decommissioning process. Do you see that? Is that fair?
I see it.
Okay, that's I'm going to turn now back to the petition that we were talking about at first, and that is Duke's petition for an accounting order, and talk about that a little bit more.
Is this the 2016 petition?
That's right, December 2016. And that's for an accounting order concerning coal ash costs. Would you agree with me that the request indicated that it was a legal asset retirement obligation that was now recognized by Duke for financial purposes for the legal obligations imposed on Duke when CAMA was enacted in 2014 and the federal CCR rule was promulgated in 2015? I'm not quoting that one. It's more of a general question.
That sounds accurate.
Okay. And we talked about this a little bit before. The first part of the request was to defer $2.1 billion, the amount of the total obligation. And it indicates, as you've mentioned, that that was something that was authorized in the 2003 order that we just went through, the commission order on ARO accounting, right?
Correct.
All right, and the other request is to defer the $434.4 4 million for the amount that was actually spent during the period January 1st, 2015 through November 30th, 2016, right?
Yes.
So comparing that, the amount actually spent and that request to the 2003 order, can you agree with me that the proposal seeks and to change how Duke accounts for its cost of removal so that the costs are not attributed to past years over the full operation of the related plants, and instead, and during the time that that coal ash was produced, and instead now the costs would be recovered from future ratepayers as the expenditures are made through a special deferral mechanism?
I'm sorry, that was a really long question. Could you repeat that?
I can. I think when you look at the request that is made in this 2016 petition, and I'm thinking back to the 2003 order that was referred to, can you agree that the proposals that are made in 2016 seek a change in how Duke accounts for the cost of removal so that the costs of removing the coal ash that was produced over the years of electricity produced at those coal stations will be recovered, instead of over the life of those assets, will be recovered in the future from ratepayers as expenditures are made for the cost of removal?
Well, I wouldn't refer to them as costs of removal. As we've laid out in my testimony, that these are costs that are asset retirement obligations. They're not costs of removal, they're asset retirement obligations. So I'm a little bit confused by your question in that regard.
So you're saying that the cost of closing the coal ash ponds and removing that waste is a new asset retirement obligation that has no relation to the operation of those plants over all those years?
It's an asset retirement obligation, which is the ARO accounting model is a different model than the cost of removal accounting model. So I just wanted to be careful that we're not kind of confusing the two. These are costs that are accounted for under ARO accounting.
Well, and you wouldn't want to count for them both ways, would you? You don't want to double count them.
No, we certainly don't want to double count them or double recover them. We just want to recover them one time.
Okay, and so is what you're saying is that in that 2003 order, then the costs of addressing the closure of coal ash ponds and the disposal of that coal ash waste, you're saying that's not a cost that's associated with dismantling those plants?
It's a cost associated with retiring those plants. They're legal obligations that fall under the guidance in both FERC and GAAP for asset retirement obligations.
And until the amount was better known because of CAMA and CCR, is it your position that they were non-legal retirement obligations?
No, it's my position under ARO accounting. These are legal obligations.
So was it a new obligation in 2016, or was it an obligation that Duke had for some time prior to that?
Became obligations upon the enactment of CAMA and the CCR rules in 2014 and 2015.
And before that, you're saying that there was not an obligation to close these ponds and dispose of the coal ash?
I'm not aware of any legal obligations prior to the enactment of CAMA in late 2014.
Okay, Mr. Doss, you've testified that an ARO obligation involves entry for both the obligation and charging the costs to depreciate that obligation over the remaining life of the related tangible asset. Do I understand that correctly?
Yes, that's correct.
So my question for you is that that total ARO of 2.1 billion, then would that be broken down for each of the plants at which the legal obligation is determined and spread out over the remaining lives of those plants?
Yes, we would have that breakout.
And so, for example, at Marshall, would the usual approach under ARO accounting, but for some sort of a rate-making order to the contrary, that at Marshall, the approach would be to recover the costs over the remaining life of the Marshall coal steam plant?
The approach would certainly be to depreciate those costs over the remaining life of the Marshall steam station.
Okay. But at Riverbend, where the plant had already been retired from some time when CAMA was enacted, would that be the sort of cost that might be written off, but for a regulatory order allowing deferral?
In the case of Riverbend or a plant that had already been retired, the initial entry would be in accordance with GAAP and FERC requirements. Initially would be recorded as a capital cost, but immediately expensed or fully depreciated because that asset is no longer in service.
I see. So in that accounting order where you asked for the deferral of those costs as they were spent, there's a reference on page 13, I think, paragraph 22, that the coal ash disposal will be deferred to a regulatory asset account 182.3. Do you see that?
Yes.
So would you agree with me that that is a FERC account in the uniform system of accounts called 182.3?
That's correct.
And that is an account that for regulatory created assets not included elsewhere, that they're included there that result from rate making actions of regulatory agencies, right?
Correct.
So when Duke used that account, is that an account that was used for from 2015, the beginning of 2015 through the time of the rate case? That how that worked while you were waiting for a decision on this accounting order request? You're muted.
So, and when we had to, upon the enactment of CAMA and the CCR rules, we were required to record entries to reflect ARO accounting, which means we recorded the obligation and we recorded the associated asset that was related to that obligation. We began to depreciate that asset as we do with any asset. And that depreciation, absent any commission directive, would have been expensed. But since we did have a commission directive from 2003 to defer the impacts, the income statement impacts, we deferred that depreciation into a 182.3 account as authorized by the commission. So the 2016 order is, or the 2016 request, pardon me, was a request that now that we have started to incur the actual cash costs associated with settling these obligations, we're essentially requesting approval from the commission to transfer those initial costs that have been deferred, which were depreciation expense. You can call them non-cash costs if you want to. They're the at Duke, we call it the theory reg asset. It's a theory a theoretical amount of costs that we have depreciated from those assets that we established. And now, in accordance with the Commission's order from 2003, which said, come to us, essentially, I'm paraphrasing, but come to us later to determine what the recovery method may look like. In 2016, we requested that we be allowed to transfer costs from that previously authorized reg asset into a new reg asset for the spend as we were incurring the spend, so that we didn't try to recover from customers any amounts until we had actually spent them. So that's what the 2016 request was accomplishing.
And is it, I think you've already been through this with Mr. Grantmeyer, but if not for that order deferring those costs under rate making for consideration in the next rate case, then they would be written off. Is that right? In the period?
These costs, effectively the depreciation expense that we had taken on these capitalized assets, if we didn't have some sort of commission directive to defer those costs, we would have to write those depreciation expenses off.
Okay, and under that account, doesn't it say within the description of 182.3, but for the accounting, based on it being probable that the cost amount would be included in a different or future period for rate making purposes, the amount would be included in that income period. That's what we're talking about when we're talking about writing it off. Is that right?
That's correct. A regulatory asset allows you to defer that cost and match that cost up over the periods that you're going to be recovering it in rates.
And that sort of recording of the deferral by Duke signals to its investors in financial statements that it anticipates that it's going to recover those costs in the future. Is that correct?
That would be correct, yes.
All right. When Duke submitted this request for deferral at the end of 2016, it based the request on 3 arguments. Would you agree with me? First, the argument was that the financial impact, if not allowed to defer the costs, would be a large hit to the company's earnings. You want me to refer you?
Is there a specific, is there a specific area of the request you're referring to?
Sure. Look at paragraph 23 on page 14. Please.
All right, Ms. Force, just for purposes of the record, please remind us which document you're looking at.
Sure. It's been admitted as AGO McManus Barrows Cross Exhibit 1, and it was submitted with AGO Probable Exhibit 43.
All right, thank you. You may proceed.
You have it? Okay. And I need to get to the right page too, Mr. You see that paragraph 23, absent the deferral, the companies may have to write off billions of dollars of costs for accounting purposes, which would, without question, would severely impair the company's financial stability and ability to attract capital on reasonable terms, right? You're on mute.
Sorry, that's paragraph 23.
Pardon me?
Yes, I see that in paragraph 23.
And then earlier on pages 12 through 13, for Duke Carolinas in particular, there's a reference to the effect on earnings relating to the 12 months ending 9/30/2016. You see that?
I do see that.
Projection of reducing earnings. So the first argument was financial impact. There was also an argument that the cost of the closure is a normal part of the life cycle of plants, but turns out to be a lot more than was anticipated. Would you agree with me that that's an argument? And it's due to government action?
And could you point me to that paragraph again, please?
Well, if you look on page 2, there's I'm not quoting it.
I'm sorry, you're looking, is the question again?
So we're talking about the argument. I'm suggesting that there were some arguments that Duke gave when it requested deferral. And the first one we talked about was the financial impact if not deferred. The second was that these are high costs. I think they're referred to as extraordinary in some places. And that they're related to government action because of the changes in regulations, requirements in CAMA. Would you agree?
I would agree with that statement. I'm not sure I understand exactly what you're referring to in this document, but I think the basics of that statement I would agree with.
Okay, and the request also referred to an earlier case in North Carolina involving PSNC. And if you look at page 15, footnote 8, there's a specific reference to it and said that in that case, the utility was allowed to defer and recover environmental costs for manufactured gas plant. You see where I am on page 8?
I see that reference.
Okay, so these were 3 reasons that Duke gave. Would you disagree with me that those are fairness arguments? That the costs are extraordinary and the impact on earnings would be great, and given to justify the request of the company to defer these costs for recovery?
I'm sorry, did you refer to them as fairness arguments?
Yes.
I'm not familiar with that term. I don't know if that's a legal term, but I think that there's clearly arguments in here.
And those would be reasons why the company is asking for special accounting treatment, deferral treatment.
Because of the new regulations, the large amount of the costs, which would, as you pointed, severely impair the company's financial stability.
And would you disagree with me that those are arguments why it's fair for the commission to allow costs to be deferred?
No, I don't think I could disagree that. I think those are arguments that are trying to establish fairness.
And to defer those so that the recovery is based on deferral of the costs as they're spent.
That's correct, yes.
Right. Okay. Now to clarify too, the comments in the accounting proceeding that were filed by various parties were received by the commission, and that accounting request was consolidated into the last rate case for decision. Do you agree with that? You remember that?
That sounds right.
So that they were addressed in the rate case order in 2018, right?
That's correct.
So, Mr. Spanos, I do have a few questions for you. In your testimony on page 28, your rebuttal testimony, you referred to resistance that you've noticed to including environmental costs as closure costs or dismantlement costs. Am I right about that?
On page 28, I'm referring to resistance in many of the decommissioning costs. So that is what's being discussed in that section on page 28.
Let me get there. And that's the section where you talk about ash pond costs, am I right? If you turn back to page 27, it's under that heading.
Under page 27, it is under the ash pond cost heading, but the reference that we are talking about on page 28 is discussing the history of decommissioning and all of the components and the resistance that utilities have received and I have received in conducting studies as to what are considered to be costs that should be recovered through depreciation expense for rate making purposes.
But you're not saying, are you, that Duke Carolinas has sought to include specific costs for coal ash disposal and closure, cost of removal, relating to coal ash ponds and disposal of the CCR and met with resistance in North Carolina in earlier cases prior to CAMA? Are you?
No, that's not the discussion that I'm having here on page 28 of my rebuttal testimony. I'm discussing more the history of the resistance that we have in recovering all of the costs that are incurred or expected to be incurred due to decommissioning for one, cost removal in certain aspects for others. So that is the discussion I'm having. It's not specific to coal ash ponds.
And you do mention a study in the Duke Energy Progress case rate case in 2012 that did include an amount for coal ash closure, right? Do you remember that?
Yes, I do. And in that particular case, there were some a study that was included in the depreciation study related to decommissioning that included some cost for coal ash closure. It's very clear that that was a very small component of what has been anticipated or expected, and now are classified as an ARO.
And so, and there wasn't any, nobody contested the inclusion of those costs in that DEP case, right? It's mentioned, but there's no real, that those costs were included, but there's no real discussion of anybody arguing against those costs being included, is there, in that proceeding?
I don't know that answer. I was not involved in that particular case to know whether there was any contention related to those costs. I know that those costs were very small in comparison to what we know today or what is expected today, and are now recorded as AROs.
Okay, thank you. I don't have any other questions.
All right, any additional cross-examination for the panel? All right, redirect for the panel.
Thank you, Madam Chair. This is Jim Jeffries. I've got a couple of redirect questions for Mr. Spanos. Mr. Spanos, do you recall some conversations with Mr. Dodge about account 366 and how net salvage was calculated?
Yes, I do.
Could you kind of refresh everybody's recollection about what the disagreement was there between the public staff and your position?
Yes, public staff had recommended a net salvage percent that was less than what's currently being utilized, and based it on the concept of expense versus a ratio of expense or incurred cost removal to accrued cost removal, and the factors, the differentials between those. And that is, as a practice, not something that's considered to be an appropriate method for determining a net salvage percent. Whereas my methodology, which was consistent with all of the other accounts, was to do a combination of statistical analysis, informed judgment, which includes not only the current estimate, but also company practices and understanding of the statistical data to make sure that the most reflective future net salvage component for this specific account would be consistent with the net salvage percent that's projected. So that was the discussion that we had, and my understanding to what was presented in front of me from Ms. McCullough's testimony and her work papers were to view what the comparison was of incurred current incurred cost to accrued cost, and that's a step that's not known to be appropriate for developing future net salvage percents.
So let me break it down a little more simply. When you're trying to figure out net salvage, you're engaged in a forward-looking cost estimation exercise. Would you agree with that?
Yes, that's a component, a major component, because we already know what has happened in the past. So the net salvage percent is to be applied on a go-forward basis. So that's the overall purpose of determining your net salvage percent. Now, you do look at what's happened in the past as a guideline, but that's just one of the pieces that allows you to have known information as part of your decision-making process.
And would it be fair to characterize Ms. McCullough's approach as being a backward-looking approach?
That is the process that we see. Now, it was a little peculiar to me that all of the other methodologies and practices of the other accounts were fine, and that particular one account would have a different approach that would reflect her methodology of looking at it as a backward approach, or comparing past incurred costs to what the accrued level would produce.
Mr. Spanos, you recall that Mr. Dodge showed you a decision of the Kansas Corporation Commission, a rate case decision involving Atmos Energy?
Yes, I do.
Okay, and that was introduced into Public Staff Spanos rebuttal exhibit, or rebuttal cross exhibit number 1, and then I think it was Public Staff exhibit 36 on their proposed exhibits. Do you have that handy? Mr. Spanos, did you hear my question?
I'm sorry. I was going to it. I apologize.
Oh, no. Okay. So I'm going to turn to it at the same time.
Okay.
And just let me know when you're there.
I do have the document in front of me.
And specifically, I would refer you to paragraph 54 in that exhibit. Just let me know when you're there.
I am there, yes.
So could you read the first sentence of paragraph 54 out of that order?
After examining the evidence on the issue of net salvage, the Commission is not convinced that it must adopt a particular methodology as the only right approach in this docket. Would you like me to continue?
Yeah, continue to the second sentence too, please.
However, the Commission rejects CURB's methodology because it relies solely on the recent historical net salvage experience.
All right. So does that appear to you that the Kansas Corporation Commission rejected a methodology that was based solely on historical experience?
Yes, that is. That was the basis of what CURB put together in their calculations in that particular study for net salvage, and they rejected that methodology.
Okay. Could you read the next two sentences, please?
Although their methods of determining net salvage differ, Atmos, staff, and CURB agree that the purpose of a net salvage analysis is to estimate the future level of net salvage that Atmos will incur as part of its depreciation expense. Both staff and Atmos agree that a net salvage analysis should estimate appropriate levels of future net salvage, not solely rely strictly on historical expense levels.
So that sounds consistent with the conversation we just had about the purpose of calculating net salvage, does it not?
That is correct. As exactly what we want to avoid doing in determining a net salvage percent in a depreciation study is you want to make sure that you are estimating what's going to happen in the future, and it's based on not only past data, but more importantly, what we know to happen going forward.
And so finally, would you read the last two sentences of that paragraph?
When deciding between Atmos and staff's net salvage analysis, the commission finds staff's approach will best balance the interests of Atmos's current versus future ratepayers. Again, this finding is not based on adopting any particular methodology in this docket, but that staff's approach strikes the best balance between current and future ratepayers.
Okay, so what the commission said is that we've got two forward-looking analysis here, and without adopting a specific methodology, we're going to choose staffs because we think it's the most balanced. But in doing so, they specifically rejected the historical approach, correct? Is that your interpretation?
That's correct. No, that's correct. They wanted to make sure that they were clear to reject an analysis that's based on historical incurred costs only.
All right, thank you. Do you recall a conversation you had with Ms. Holt yesterday where you and her were having a discussion about what I would characterize as the public staff's approach to early plant retirements, and she took you through a number of orders or petitions where folks had either agreed or proposed to use this amortization approach when faced with the early retirement of physical facilities. You recall that conversation?
I do.
And that's not the approach you propose with respect to the early plant retirements in this case, correct?
No, I've consistently recommended to utility companies that you need to follow the appropriate practices that is within the industry, and that is to recover your investment over the life cycle of the assets, and those probable retirement dates are what we know at the point in time of conducting the study, and that's what is the most appropriate manner in which depreciation expense should be recovered, consistent with general principles and practices within the industry.
And put really simply, isn't it, from your perspective, isn't it better to use current depreciation rates rather than outdated depreciation rates when calculating depreciable lives?
Yes, whenever you can incorporate not only the most up-to-date data, but also the most up-to-date information and knowledge to be expected, that would be the most appropriate thing to do versus going back and just maintaining expectations of what had happened years ago. So it's very beneficial, and the purpose of conducting depreciation studies is to ensure that you're getting the most appropriate information to help your informed judgment, which is the standard that all authoritative text instruct is to follow the guidelines, not only the Uniform System of Accounts, but also the guidelines that are in place for conducting an appropriate depreciation study, which includes informed judgment, which would be information as currently as possible.
Thank you. That's all the questions I have for Mr. Spanos, Madam Chair.
Madam Chair, I do have some redirect for Mr. Doss.
All right, proceed, Mr. Marzo.
Thank you, Chair Mitchell. Mr. Doss, I want to start with, I believe it's AGO 43, which is the company's 2016 application that Ms. Force had asked you some questions about. Do you recall that document?
Yes, I do.
Yeah. Now, you were asked about the recovery of coal ash costs in the 2016 deferral application. Now, for clarity, at the time that application was made, coal ash costs were an asset retirement obligation. Is that correct?
That is correct.
And was the request, and the request in that particular deferral application wasn't to treat those costs as cost of removal. Is that right?
That is right.
Now, is the regulatory deferral part of the regulatory model for ARO recovery for regulated utilities?
Yes.
Okay, and in fact, if I look at the 2016 application, am I correct that in addition to the application itself, it also has an attachment? And I believe that attachment is the Savoy letter. Is that, do you have that?
That is correct.
AGL 43? Okay.
Yes, I do.
And I'm going to read something on page 6 of AGL 43. I'm going to ask you some questions about it. First off, on page 6, under assets associated with the liability recorded related to AROs, there is the paragraph that states, at the time the ARO liability is recorded, a corresponding and equivalent ARO asset is recorded on the books as part of the cost of the associated coal plant in the property, plant, and equipment accounts, or if associated with the retired coal plant, recorded in regulatory asset. The ARO PPE balance is depreciated over the remaining estimated plant lives, and such depreciation expense is deferred to regulatory asset account. Is that summarize the treatment that the company utilizes for its ARO recovery for coal ash costs?
Yes, that's a good summary.
Okay. Now, if I go down to page 7, at the top of page 7, there's a discussion of why the deferral takes place. In the first paragraph, and I'm going to read this and ask you to explain it to me. It says the FASB recognized that differences may exist between the requirements of ACS 410-.20 and the treatment of ARO costs for regulatory purposes, and accordingly provided that a regulatory entity subject to ASC 980, regulated operations, formerly SAS 71, accounting for effects of certain types of regulations, could recognize a regulatory asset or liability for any difference between the two approaches, if the facts and circumstances meet the requirements of ACS 980 for such recognition. Now that sounds to me that relates to the matching of when costs are incurred and when they're recovered for regulatory purposes. Am I understanding that correctly?
You are understanding that correctly. That's right.
Okay, and does the company's actions in this case, as it pertains to this ARO, does it meet the requirements of ACS 980 under FASB?
Yes, it does meet the requirements under ASC 980 for the deferral of these costs into a regulatory asset.
Now, the commission's deferral order, is that just the final component of the model that we essentially call the ARO recovery model? So they all work collectively together as one system for cost recovery, making sure that the costs that are incurred are matched with the time in which they're recovered.
Yes, I would agree. I mean, it's all just sort of a continuation of the process that was established in the 2003 order from the commission, in which we were directed to defer the impacts until they could be considered in a future proceeding. And this 2016 order is just a continuation of the process that the commission established for addressing these costs.
And you mentioned that this actual application for 2016 is not the last time the commission has spoken on ARO recovery, correct?
That is correct.
Okay, would the commission's order in the last rate case be the most recent time that they spoke into ARO recovery for Duke Energy Carolinas?
Yes, it would.
Do you have that order in front of you? And it's DEC cross exhibit number 1 if you need to find it in your materials.
I do have that order.
Now, would you turn to page 283 of that order? And you just let me know when you get there.
I'm sorry, I'm there.
Okay. Would you mind reading from the last paragraph on page 283? It carries over slightly to the following page, which is 284.
Sure, starting with that paragraph, it says, first, the commission disagrees that the company chose ARO accounting. The commission has already so held in the 2018 Duke Energy Progress case that once it became clear that the new laws and regulations governing coal ash would require closure of the company's existing coal ash basins, GAAP required that an ARO be established, and the company had no choice in the matter.
If you keep going just to the end.
Sure. The next sentence reads that further, as company witness Doss testified, in addition to GAAP requirements, the company was also required to and did adhere to and apply the accounting guidance under the FERC Code of Federal Regulations, as well as orders of this commission. The company's ARO accounting complies with the authoritative statements of GAAP, FERC, and this commission.
Thank you, Mr. Dawson. As it pertains to the costs being sought for recovery in this case, are those statements still correct in regards to our compliance with GAAP, FERC, and the commission's orders?
Yes, it's still consistent, still the same.
Okay. And you were asked a number of questions. I think even earlier, Mr. Spanos may have got some questions about, well, what if we just don't follow the uniform system of accounts? What can't the commission deviate from the uniform system of accounts? Mr. Doss, as the head accountant at Duke Energy Carolinas, and as someone who I know understands entirely the purpose behind the uniform system of accounts, what are some of the dangers with considering a deviation from the uniform system of accounts as being suggested by some parties?
Well, it would give me a great pause, you know, based on my experience in doing accounting and as being a CPA for 35 plus years. You know, generally accepted accounting principles and the FERC system of account are established so that companies have guidelines to follow, and so that investors and other users of the financial statements know that that the books and records are prepared on a consistent basis and that there's comparability across companies. So it would give me great pause to think that we might be considering anything that would deviate from the either GAAP or from the FERC uniform system of accounts. I think that you know, even just as implied by the FERC's name for it as a uniform system of accounts, there's great value to the financial community and I think to others who use the financial statements to have that assurance that utilities are on a uniform system of accounts and there's comparability, consistency across utilities. And I think it's extremely important really in the case of Duke Energy Carolinas and Duke Energy Progress for that matter, where we are operating in 2 states and we also have FERC customers. So it would give me great pause to think that we might be thinking about doing something different, establishing some different accounting model within the state of North Carolina that would not only deviate from every other utility in the industry, but also deviate from what we might be doing in our other jurisdictions, as I will call them, in South Carolina and the FERC jurisdiction within Duke Energy Carolinas.
And does that create a situation where you potentially could be looking at 2 sets of books, which I know is a scary thing for someone in your position, correct?
It is a scary thing to think about, and I can't say that I've fully considered all the potential impacts that might come about from that, but it could very well result in having a different set of books, certainly which would create a heavy administrative burden on the company. And I think, as I said before, for users of the financial statements, potentially create a lot of confusion out there in trying to compare Duke Energy Carolinas, North Carolina jurisdiction to the others, as well as trying to compare Duke Energy Carolinas overall to other utilities in the industry. Not to mention that, you know, when we have our books audited, there's an audit of our GAAP books to the auditors will opine that the books are materially correct according to GAAP principles. There's another audit that's done on our FERC books. And like I said, I haven't considered all the implications, but would we potentially have to have a North Carolina set of books that we might have to do something similar for? So again, not having given it full consideration of all the potential implications, it's just something that I would put out there, something that I think that I would hope that we would all consider very carefully.
And you got some questions from Mr. Grantmeyer earlier, and I think he was referring to your Exhibit 1, which included subtopic 15-2 related to the normal operations and ARO treatment. Do you recall those?
I do recall that, yes.
Now, just to be clear, the costs that are being sought for recovery in this case, they're part of what is normal operations, correct?
That's correct.
Okay, I think Mr. Grantmeyer may use the term improper operations, but that's not anywhere within subtopic 15-2, that terminology. Is that correct?
That's correct. Improper operations would not fall under the guidance for ARO accounting.
And I think you were asking questions about Blues Creek, the extraction well recovery. Just for the record, is it your understanding that the cost for the extraction wells was recovered in the last rate case?
I believe that to be the case.
Okay, so the commission did allow recovery, that the amount of recovery that was included in that case to be recovered in that case.
I believe that's correct.
Okay. Now, you and Mr. Spanos were asked some questions about AGO, I believe it's Exhibit 29. And this is the decommissioning handbook for coal-fired power plants. I think Ms. Forrest asked you some questions regarding this. Is that correct?
That's correct.
Okay. And I think she cited you to one page, and I didn't write that page down, but I did want to refer you to another page of the document. If you would turn to page, I think it's page 4 in Roman numerals. The heading at the top is results.
Yes, I'm there.
Okay. Now, do you see where essentially it discusses 3 different ways that they're looking at decommissioning projects and basic options? Do you see that? And one of those options is to maintain the site as present condition with minimal cleanup, meet environmental compliance, and ensure safety. The other one is perform minimal dismantling and demolition while maintaining the site to meet environmental compliance requirements and ensure safety. The other one is dismantlement to a degree required to meet specific needs of planned reuse to the site. And the final one is full decommissioning, correct?
Yes, those are the options that are presented here.
I know you're not familiar with this report, but are you familiar with, or do you know whether or not any of the sites here are sites that would provide information in terms of what Duke might do for Duke Energy Carolina's facilities? Do you know if their sites are analogous? Is the way I should ask that question.
I'm sorry. Could you repeat that question?
Yeah, I was asking, do you know if any of these sites are really analogous to Duke Energy Carolina sites?
I don't really know. I mean, this is a range of options, and I assume that there could be some applicability to Duke Energy sites, but not being familiar with this document, and it would be hard for me to say with certainty.
Yeah, and that's fair enough. And I know this is the first time you're seeing this document, Mr. Dahl, so I think that's fair. And of course, Ms. Bedarsic, Mr. Wells, and Ms. Williams can speak more about it if there are more questions on it. I did want to point you, well, let me ask you this question. Clearly, one of the things to consider is one of the things to consider within this document is whether or not what options a utility is considering in terms of reuse of a site, correct?
Correct.
Would that be something you consider? Okay.
Yes.
Would you turn to me to page A6 of this document, which refers to one of the test case of the 3 test cases that are included in this document? And this refers to a Georgia Power Plant, which is Georgia Power Plant Arkwright. which was decommissioned sometime around 2003 or 4, I believe, 2002, 2003. Do you see that paragraph at the middle of the page that starts with "after the plan is retired"?
I do see that.
Okay. Now, if you go one sentence down into that paragraph, tell me if I'm reading this correctly. It says, in agreement with the state regulators, pond number 1 was closed with a cap under 1988 regulations, which were in effect when the pond was retired. Does that suggest that the state regulators had significant input into the process of closure?
Yes, it does.
Okay. Thank you, Mr. Doss, on that. Now, I just want to refer back to one more line of questions. Now, if you look at your testimony or you look at the order from the last rate case, and you look at the paragraph right below the paragraph I had you read, that's on page 284. Could you read that paragraph for me? It starts with witness Doss.
Yes. Witness Doss provided an extended explanation of the GAP, FERC, and deferral directives that govern the manner in which the company established the ARO and has accounted for coal ash basin closure costs in the ARO. The commission credits his explanation and testimony, which are uncontradicted.
Now, there's been some discussion in the current case, and maybe even an allusion that some individuals may have been confused as to how ARO accounting has occurred. Did you review the commission's determination in the last order?
Yes, I did.
Now, does that discussion cover several pages, including sections specifically designated GAP, FERC, commission deferral order, and summary of accounting rules deferral, the Savoy letter, and the procedure for establishing a deferral?
Yes,
Are those all sections in the order? Okay.
Yes.
Now, I think we said this earlier, but DEC has not deviated from the recovery process as outlined in that order, correct?
No, DEC's accounting practices throughout this period, beginning with 2015, have been consistent.
Do you believe there was any confusion in the last case as to how the company's ARO accounting would work?
No, I don't see how there could be confusion. I believe even in this order, the commission stated that through the Savoy letter, we had, explained exactly how the accounting was going to work. Going back to the time of the Savoy letter, that was 2015, the deferral request from 2016, the last 2 rate cases, the DEC and DEP rate cases. I think we've been very consistent, very transparent, I think, in how we've been doing the accounting, and we've been consistent throughout the years. We've responded, as far as I know, to every data request, any request for additional information related to how we're doing this accounting. And now almost 5 years later, in 2020, after we established the framework for it and the ARO accounting and how we explained it in the Savoy letter in 2015, we're still doing it the same way. And I think that there's been ample opportunity for any interested parties to be able to ask questions. And as I said, we've done our best to be transparent and answer any questions that have come our way. So I don't know why there would be any questions here, since I think we've had 5 years to kind of get a good understanding of the accounting that we're applying.
Thank you, Mr. Doss. And one last set of questions. You were asked by Mr. Grantmeyer, I believe, primarily, maybe a little bit by Ms. Force, some questions related to used and useful. And I'm going to ask you, under GAP and FERC accounting guidance, are the assets created when the company recognizes the ARO considered part of the property, plant, and equipment for the asset?
Yes, they are.
And is that consistent with these capitalized assets being treated as used and useful property?
Yes, it is.
And are there ARO capitalized assets are these assets intended for environmental compliance?
Yes, they are.
Are they intended for the retirement of the ash impoundments and the final storage location for residuals from generation of electricity?
Yes, that's as I stated in my testimony, that is true.
Okay. Thank you, Mr. Doss. Chair Mitchell, I have no further redirect.
All right, question. At this point in time, actually, we are going to take a break. Let's see, it's 10:55. We'll go off the record now. We will be in recess until 10 after 11.
Please turn off your video. Thank you.
right, let's go back on the record, please. We will begin with questions by the commissioners. Commissioner Brown Bland.
No questions.
All right. Commissioner Gray. Commissioner Gray, any questions from you?
Sorry, no questions. Thank you.
Okay. Let's see. Commissioner Clodfelter.
Yes, thank you. Mr. Doss, I've got just a couple of questions for you. Can you hear me okay?
Yes, I can.
Okay. My questions are prompted by a document, but I'm not going to ask you questions about the document. It's just the document's what prompts the questions. And it's really a question about the transition to ARO accounting when that occurred. In the last DEC case, we had as an exhibit to the testimony of David Fountain, it was an Attorney General's cross-examination exhibit 6. It was a presentation by Jason Allen and David Fountain to the Senior Management Committee in January 2014. That was before the Dan River spill and before CAMA was enacted. And they were discussing in the document the situation regarding the coal ash impoundments at the various Duke plants. And one of the topics that was discussed in the document and in the presentation was the potential for using the then accumulated cost of removal reserve attributable to the steam production plant, the possibility of using some of that to offset what was expected to be incurred with respect to closure or remediation of the coal ash impoundments. And they showed in the document that there were certain balances that had accumulated for each of the affiliated companies. So my question really to you is not about the document, but at that point in time, clearly no decision had been made by the company about whether to deploy those accumulated costs of reserve amounts that have been collected through rates to deploy that to offset any of the expected coal ash expenditures. So my question to you really is that when the point in time came when the ARO accounting was established, was any portion of that accumulated steam production plant cost of reserve taken into consideration in making the cumulative adjustment?
Commissioner Clodfelter, for Duke Energy Carolinas, it was not. As I think you're aware, for the Duke Energy Progress case, there was a little bit of a very small amount that had been collected. But for Duke Energy Carolinas, there was nothing specifically earmarked that we could transfer.
So when the cumulative adjustment was made, when the ARO accounts were established and the cumulative adjustment was made, no part of that was included in the adjustment. And is that because the company considered that that had been collected in rates on account of decommissioning costs other than coal ash costs? Is that why no part of that was taken into account in the cumulative adjustment?
That's right. And as witness Spanos can also opine on this, but at that time, there were no amounts that had been specifically collected from customers related to the retirement of these coal ash ponds. So there was no amount for us to transfer in the case of Duke Energy Carolinas.
That's what I thought was the case, but I needed to ask you because you actually did the making of the cumulative adjustment when ARO was established. I needed to know that I understood the sequence of events correctly. There in that presentation, Mr. Fountain and Mr. Allen said that there were different points of view as to whether or not that accumulated cost of removal reserve could be tapped for purposes of coal ash closure, pond closure, or remediation. And Mr. Allen and Mr. Fountain say there are two different points of view. One is that we can do it, the company can do it. Another point of view is that no, we need to notify the regulators. Do you know if that difference of opinion was ever resolved within the company before CAMA was enacted?
Well, I would tell you, and this exhibit was put before me as well, Commissioner Clodfelter, in the last case.
I had forgotten that. Thank you for reminding me. I had forgotten.
Yeah. Yeah, and I was not involved in the preparation of this or in my role at that time, but I would tell you these are my thoughts when I look at this.
Okay.
Those notes that you referenced, those were actually some notes that were at the bottom of the slide. And
Okay.
as anybody who knows who's ever prepared some presentations in PowerPoint, you might have some notes that you put into it as you're developing your slides. And in fact, they might be left over from previous versions or draft versions that you're working on. So the points of view, those different points of view that you reference, I noticed that's in the notes section. What I would say, and I'm speculating here because as I said, I wasn't involved, but I would focus on the actual slide itself. And on the actual slide itself, it doesn't even go into those points of view. It concludes that regulatory approval would likely be required to do any sort of a transfer between these cost of removal reserves.
And that would be true. Regulatory approval would have been required because the cost of removal reserve was accumulated in consequence of approved depreciation studies that did not include any costs associated with the coal ash ponds. That's why regulatory approval would have been required. Is that correct?
Yeah, that's right. And I would say that as the accountant, that would give me, I'd be very concerned about, and I don't know if accounting was, consulted for this presentation or not, but I would say that, that would give me some great concern. We have very scientific studies for these cost removal reserves, and they're done by function. As I look at this slide, it seems to indicate that they were thinking maybe some could be potentially reallocated. And granted, we know at this time that this was sort of a developing story, if I could use that sort of a term, and that there was a lot of difference. The costs were constantly changing. It's my understanding, and the views on using cost removal, I think, were people were trying to come to grips with what could potentially done with cost of removal reserves. Sitting here today, looking back on it, and where we are with our cost removal reserves now, they're so scientifically calculated. And John Spanos can touch on this too, as well. That to try to raid one of the other functions reserves, I think we need to think about that very carefully, because those reserves are, done under calculations to make sure that they're adequate. It gives me concern that maybe at this time there was some thought that there was some excess reserves or something like that available to use. But I don't believe that we have, especially in the steam reserve right now.
But you've answered my principal question, which is,
okay.
In fact, a reallocation or reassignment or redeployment did not occur. In fact,
it did not occur.
Because if it had occurred, you would have had to show that in your cumulative adjustment.
That's right. That's right.
And you did not do that.
We did not. And again, to do any sort of transfer like that, I think likely would have required us to come to the commission.
Thank you, Mr. Doss. I just needed to be sure I understood the history accurately and that the numbers flowed the way I thought they flowed. Thank you.
Absolutely.
That's all. I have nothing further.
All right, Commissioner Duffley.
I just have one question for Mr. Doss. I just wanted to clarify your testimony. You were talking about concerns that you had about a deviation of the current accounting practices that the company has set up, and that you would have to carry 2 sets of books, but you weren't specific in what kind of potential changes that the commission was considering. Are you speaking? Well, I'll just ask you, what exact practice are you speaking to? Or potential change?
Potential change. I think that there was an exhibit presented earlier in the case. I don't recall exactly by whom, but and it was around the rules where the commission has adopted the FERC uniform system of accounts as the North Carolina system of accounts, essentially. I think in that rule, it also states that the commission at its discretion, could make a deviation from the FERC uniform system of accounts. And it seemed to me that maybe in some of the earlier testimony I heard, and maybe I misinterpreted, but I thought I heard some hints that we might consider doing a deviation from the FERC uniform system of accounts. And so I just wanted to make sure that I expressed my concern if there were any thoughts that we might be entertaining something like that.
And what would that deviation be? I mean, what were you assuming that deviation would be?
Well, for instance, and I'm thinking in terms of the recent Dominion case, and there was some talk about using cost of removal, sort of commingling cost of removal and ARO accounting, and they're two separate and distinct things. I think that upon reconsideration, that was sort of straightened out in the Dominion case, but that's just one example.
Okay, thank you. No further questions.
No questions for me.
All right, thank you, Commissioner Hughes. Commissioner McKissick?
No questions at this time.
All right, thank you, Commissioner McKissick. Mr. Doss, I do have one question for you, and I hope you can just tell me this off the top of your head. Do you recall the point in time at which DEC first recognized or initially recognized CCR-related AROs?
Yes, that was in the third quarter financial statements of 2014.
Okay. Okay, thank you, sir. All right, we will entertain questions on commissioners' questions, starting with interveners.
This is Bill Grantmeyer, Public Staff. I have one question, one or two follow-up questions for Mr. Doss on Commissioner Duffley's question. You were asked about deviations from current accounting practices, but on your audited financial statements, don't the auditors make notes or have notes inserted on the audited financial statements explaining any deviations from GAAP accounting?
Well, first of all, I can't think of any deviations.
If the commission, I'm sorry, go ahead and finish.
No, I'm trying to make sure I give you a full answer on that. And I'm thinking on our GAAP statements, I'm not aware of any notes that the auditors make or that we've made as far as deviations from generally accepted accounting principles.
Well, if in fact the commission ordered that the ARO deferred costs be recovered over 25 years with no return, would that be a deviation from GAAP accounting principles?
I don't know that would be a deviation from GAAP accounting principles. I think that might be a deviation from what the company would consider to be fair principles. But from a GAAP perspective, we have had in the past regulatory assets that are where a return may not be granted in some cases, and we would, to the extent that that is a material issue, that could be noted in the financial statements.
Thank you. I have nothing further.
All right, any other questions on commissioners' questions from intervening parties? All right, Duke?
Yeah, just a couple, Chair Mitchell. Just real quickly, Mr. Doss, I want to make sure I completely understand for clarity of the record in regards to the steam reserve. As you stated earlier, could you elaborate further on the concern there with the use of dollars that are not already allocated for the steam reserve?
Certainly. I think our concern is that there may be some thought that there's an excess reserve there to use. And so our analysis shows that there is, in fact, there's not, when it comes to the steam production reserve, there's not an excess reserve. In fact, we think that the reserve is adequate, but it's not at the level that our current depreciation study shows that it needs to be. It shows that it still needs to be built up over time. We've got a late filed exhibit that shows, and this was in response to Commissioner Clodfelter's request that we elaborate on the Spiros exhibit around cost of removal, that will show that reserve, for instance, is around 130 million currently. Based on our depreciation study, it shows that we need to build that reserve up to some $400 million in the coming years. So while we feel like it's adequate now, it needs to be built up. I just wanted to make sure that there wasn't some thought that we have excess reserves that could be used to help fund these coal ash remediation costs.
Thank you, Mr. Doss. In regards to the question that commissioners asked you regarding the concern about not applying FASB and FERC requirements, that does not, when you said you had a concern related to that, am I correct that that is not evidence a concern that the commission can make alternative rate making decisions, but those decisions can be made and still be consistent with FERC and with FASB regulations? Is that a fair way of putting it?
Absolutely. I think that there are just a number of options and alternatives in the accounting and in the rate making that are consistent with FERC requirements of the FERC Uniform System of Accounts. So I would hope that we could come to some sort of a resolution that would allow us to stay within the confines of FERC and the confines of GAAP. Without doing some sort of a deviation that, and I'm not an attorney, but it appears like in the rules that the commission potentially could have the authority to deviate from FERC rules. So that was all I was the point that I was just trying to get across, is that I think that we should all, I would hope that we would proceed cautiously with any such ideas in that vein.
Thank you, Mr. Doss. Are you familiar with the company's late file exhibit, I believe, in response to Commissioner Duffley?
And if you could remind
it's Exhibit 1. It just has various cost recovery scenarios on it.
I would object. I don't remember any questions on commissioners about cross Exhibit 1 or late filed Exhibit 1.
Well, let's see where he's going with these questions, Mr. Marzo.
Mr. Dawson, and I'm going to try to stay exactly to the commissioner's question in regards to FASB and FERC requirements. Are you familiar with that exhibit first?
I might need to put my eyes on it to refresh myself with that one.
Okay, it is the exhibit that has various ash space enclosure cost recovery scenarios and impacts on it. And it was filed on, I don't have the exact file date.
September 2nd.
September 2nd. Thank you, Chair Mitchell. I'm just going to ask you one brief question related to that. So,
yes, let me get that one here. Okay, I'm sorry, I do have that one in front of me.
Okay, so when you expressed the regulatory concerns that we would have for deviations from FASB and FERC and for regulatory precedent at the commission, you were not suggesting that the commission can't consider various scenarios for rate making, only that those scenarios should be consistent with rate making, correct?
Oh, absolutely. Yes, I understand the commission has authority to consider all types of scenarios. Okay. Again, my concern being expressed there was that we just stay within the confines of FERC and what's considered to be in compliance with the Uniform System of Accounts.
Yeah, thank you, Mr. Doss. Chair Mitchell, I have nothing further.
All right, Mr. Jeffries, any from you?
No questions, Madam Chair.
All right. At this point in time, we will entertain motions.
Chair Mitchell, this is Tim Dodge with the public staff.
All right, Mr. Dodge.
During my cross-examination of Mr. Spanos yesterday, I asked that Public Staff Exhibit 36 be marked as Public Staff Spanos Rebuttal Exhibit 1. And in so naming, I neglected to recognize that the witnesses were appearing as a panel. I believe Ms. Holt also followed suit. So to clarify the record, I would request that the 3 Public Staff Spanos Rebuttal Cross Exhibits be relabeled as Public Staff Spanos DOS Rebuttal Cross Exhibits 1 through 3.
All right, Mr. Dodge, thank you for that clarification. The 3 public staff cross-examination exhibits will be labeled as public staff DOS Spanos rebuttal cross-examination exhibits numbers 1, 2, and 3.
Thank you. And with that, I would also request that those 3 exhibits be admitted into evidence.
All right, hearing no objection to that motion, Mr. Dodge, it will be allowed.
And
This is Bill Grantmeyer, Public Staff. I would request that Public Staff DOS rebuttal cross-examination exhibits 1 and 2 be admitted into evidence.
All right. Well, Mr. Grantmeyer, as Mr. Dodge and I have just been discussing, because DOS and Spanos were a panel, and Mr. Dodge has asked that the exhibits be labeled as DOS Spanos. Let's do this. Actually, you're about to say something, so proceed.
Yes, I would request that instead of DOS 1 and 2, they be renumbered Spanos DOS exhibits 3 and 4. I'm sorry, 4 and 5.
All right, the documents will be relabeled as public staff DOS Spanos rebuttal cross-examination exhibits numbers 4 and 5.
Thank you.
And Mr. Grantmeyer and Mr. Dodge, I would ask that you keep a close eye on these documents and just work with our court reporter to ensure that they are appropriately labeled in light of the relabeling that is occurring.
Thank you.
Thank you.
All right, Mr. Grantmeyer, did you move those documents into evidence?
I believe so, but I will do it again. I would move those documents into evidence. Thank you.
All right. Hearing no objection to that motion, Mr. Grantmeyer, it's Mr. Marzo, are you objecting?
The same objection before, just the lack of authentication to those documents, because those are documents that Mr. Doss really could do nothing more than to read the information on the document.
All right. Well, noting your objection, Mr. Marzo, I'm going to allow the documents to be admitted into evidence. All right. Any additional motions from the parties?
Chair Mitchell, I'd ask that the supplemental testimony and the rebuttal testimony of David Doss and his exhibits be entered into the record.
All right, hearing no objection, Mr. Marzo, your motion is allowed.
And Madam Chair, just for the sake of the clarity of the record, Mr. Spanos had no exhibits to his rebuttal testimony.
All right, thank you, Mr. Jeffries. All right, with that, Mr. Doss, any additional motions?
Chair Mitchell, I'd move that AGO Doss Spanos rebuttal cross exhibit 1 be admitted into evidence.
All right, Ms. Force, hearing no objection to your motion, it is allowed.
Thank you.
Okay, with that, Mr. Doss and Mr. Spanos, you may step down. We appreciate your testimony this morning.
Thank you.
And I believe, for clarity, your witnesses are excused as well. All right. Mr. Heslin, you're up.
Yes, good afternoon or good morning, Chair Mitchell. I'd like to call Sean Riley to the stand.
All right, good morning, Mr. Riley. Let's get you sworn in. Would you raise your right hand, please? Do you affirm that the testimony you're about to give shall be the truth, the whole truth, and nothing but the truth?
I do.
All right, thank you. You may proceed, Mr. Heslin.
Thank you, Chair Mitchell. Mr. Riley, could you state your full name and address for the record, please?
Sean Patrick Riley, 601 South Figueroa, Los Angeles, California.
And what company do you work for?
PricewaterhouseCoopers, sometimes referred to as PwC.
And could you provide a short description of your role with the company?
I'm a partner in PwC's National Power and Utilities practice. I have several roles in the company. I am an audit partner serving large regulated utility audit clients, as well as I lead what's called our complex accounting and regulatory solutions practice. And as part of that, we provide consulting services to regulated utilities across the U.S.
Thank you. And on March 4th, 2020, did you cause to be filed pre-filed rebuttal testimony consisting of 33 pages and 1 exhibit?
Yes.
Do you have any changes or corrections to your testimony or exhibit?
I do not.
If I asked you the same questions today, would your answers be the same?
Yes.
And did you prepare a summary of your testimony?
I did.
Thank you, Mr. Riley. Chair Mitchell, at this time, I would move that Mr. Riley's pre-filed rebuttal testimony and his summary, which was provided to parties and the commission previously, be entered into the record as if given orally, and that Riley rebuttal exhibit 1 be marked for identification.
All right, hearing no objection, Mr. Heslin, the motion is allowed.
Thank you, Chair Mitchell. Mr. Riley is available for cross-examination.
This is Bill Grantmeyer with the public staff. Mr. Riley, on page 7, lines 3 and 4, you state the prices charged by a rate-regulated utility are based on the utility's cost of providing service, including both capital and operating costs. Would you agree that regulatory commissions sometimes set rates that do not cover all prudently incurred utility costs?
Yes, I would agree.
And one example would be that a percentage of senior executive salaries are sometimes excluded from rate recovery?
Yes, that is true. Although I would say that for many utilities around the country, in many cases, utilities follow a holding company structure. So some senior executives sit in the holding company as opposed to the regulated utility. So it really depends on the structure of the utility.
But those senior executives, some of their salaries would be allocated to the operating utility. Is that correct?
That's correct.
And you're aware that commissions have disallowed or had some type of sharing of board of directors compensation and expenses?
Yes.
And also commissioners have disallowed promotional advertising and lobbying expenses may be excluded from rate recovery?
Generally speaking, civic and political activities can be construed as what is called below the line, and therefore are shareholder costs, not ratepayer costs.
And also the unamortized balance of nuclear cancellation costs have been denied a return, haven't they, even though they may have been prudently incurred?
I would need some specific examples on that.
Well, that Sharon Harris plant that was canceled, wasn't that denied a return back in the 80s? It was a construction plant.
I'm not familiar with that situation.
And so there are situations when commissioners do disallow in rate making prudently incurred costs, in summary.
I'm pausing because you're using the word prudently. It really depends on the situation, but in general, if there's a disallowance, it's the view of the utility, the commission that such costs were not prudently incurred.
Well, payment to senior executives may be a prudent payment, but there's some sharing with the shareholders, correct?
Sure. You were referring to disallowance, and so that's what I was responding.
Okay. Now, page 8, you discuss on lines 10 through 13, you discuss how SFAS 71, now ASC 980, allows certain costs to be deferred for future recovery instead of expense when incurred, correct?
That is correct.
Are you aware that North Carolina is an historical test year jurisdiction?
Yes.
And is it fair to say that in an historical test year jurisdiction, an unexpected utility expense would normally be deemed to be recovered in existing rates and not deferred?
For purposes of applying ASC 980, there are various ways of deferring or bases to defer incurred costs. ASC 980 specifically says that if an entity determines that an incurred cost, an expense, is considered probable of recovery in the future from ratepayers, and that could be based on past precedent at that particular utility with other utilities or by other means, then such amounts could be deferred as a regulatory asset because they're, again, considered probable of recovery.
But in rate making, I'm talking about rate making rather than the accounting rules. A utility expense that's incurred in a year would normally be recovered in existing rates, would it not, and not be deferred absent a deferral approval by the commission?
Generally speaking, you would expect cost of service items to be recovered in the year that they're incurred.
And would you agree that in a jurisdiction like North Carolina, historical test year, the prohibition on retroactive rate making would normally bar a utility from recovering in future rates a past cost?
I'm not familiar enough with North Carolina law to answer that question.
Do you agree that deferral is an exceptional regulatory tool that protects utilities from a significant drop in rate of return when there is a significant unexpected expense?
No, that's not the purpose of ASC 980. It's been mentioned in other testimonies. ASC 980 is effectively a matching of expenses with the recovery of those expenses from customers. And so it's in many cases either viewed as our commissions look to either have costs recovered in a particular year or as they're managing rates over a period of time. But I would not call them exceptional.
Are you familiar with General Statute 62-133 that sets out for the commission what is to be included in rates?
I am not.
Well, would you accept, subject to check, that ASC 980 is not mentioned at all in that statute?
Subject to check, certainly.
And would you also accept that there's no mention of gap in that general statute, 62-133?
Subject to check, certainly.
And would you also accept, subject to check, that GS 62-133 has no mention of FERC?
Again, subject to check, certainly. Yes.
Now, you explained that FASB standards apply to regulated utilities on pages 7 to 12. Do you agree that for state retail rate making, state law takes precedent over FASB standards if the two differ?
I would like to clarify that when you're talking about state law, I believe you're talking about rate making and what to charge to ratepayers. GAAP, generally accepted accounting principles in ASC 980, are financial reporting standards, accounting standards for financial reporting for entities such as DEC. And so one doesn't override another. I talk about it in my testimony. Accounting follows rate making. So as rate making and rates are established, the company, for purposes of its financial reporting, must apply GAAP, including ASC 980, which would take into account those considerations as it relates to rate making.
Now, would you agree that without deferral, the ongoing accretion and depreciation expenses for ARO coal ash costs would not be recovered in a historical test year jurisdiction?
I'm sorry, you said without deferral, sir?
Yes.
Yes, that is correct.
So is it fair to say that when a regulatory commission allows a deferral of coal ash closure costs, it changes the rate-making treatment that would otherwise have occurred under FASB ASC 410?
I'm sorry, sir. Can you repeat the question again?
So is it fair to say when a regulatory commission allows deferral of coal ash closure costs, it changes the rate-making treatment that otherwise would occur under the application of FASB ASC 410? Would you agree with that?
I would, but I just clarify. I got confused at the last part of your ASC 410 deals with accounting for asset retirement obligations. Rate making is outside of ASC 410. ASC 410 does not drive the rate making associated with asset retirement obligations.
And I would turn you to page 10. You've already testified to some of this, but we'll go through it very quickly. Page 10, lines 7 and 8, would you please read that into the record? The line 7 that begins with the important point.
Certainly. The important point here is that for utilities, accounting follows rate making, not the other way around.
And if we could go to page 12, lines 12 through 14, could you read that into the record?
Yes. The important point here is that the GAAP accounting for rate regulated utilities follows the rate making process to reflect the unique economic consequences of rate regulation.
And on page 17, line 16, could you read that first sentence beginning with generally?
Generally, regulators ignore ASC 410 for rate making purposes.
And also on page 21, line 4, I'll read the question. If you could read the first 2 sentences. Does ASC 410 contain guidance on the rate-making treatment of legal ARO liabilities or other non-legal costs of removal? You would read the answer.
Answer, no. ASC 410 and other FASB pronouncements do not address rate-making treatment. ASC 980 addresses the accounting based on rate-making treatment.
And it also says the next line 6 and 7. Could you read line 6 and 7?
However, ASC 410 acknowledges that many regulated entities recover asset retirement costs differently than how GAAP may recognize the related expense.
Now, on your PricewaterhouseCoopers, is that correct?
That's correct.
And on PricewaterhouseCoopers audited financial statements, what is the sentence they use that says that the company complies with GAAP? They issue an unqualified opinion that they comply with generally accepted accounting principles. What is that wording? Do you remember?
Well, PricewaterhouseCoopers is a private company and we're not audited, but if you're asking what
No, when they issue an audit opinion, I'm sorry.
Oh, I see. Yes. When we issue an audit opinion, well, effectively, and what an audit opinion is an independent audit firm such as PricewaterhouseCoopers, and we are, by the way, not the auditors of Duke. If we were to issue an opinion on DEC, for example, if it's considered unqualified, it means they're complying with generally accepted accounting principles and that the financial statements are fairly presented in all material respects.
And the audit reports also have footnotes that explain unusual circumstances. Isn't that correct?
I wouldn't call them unusual circumstances. In accordance with generally accepted accounting principles, there are required disclosures following all of the generally accepted accounting principles that apply to a particular entity. And that's what companies would include in their footnotes. In addition, as a public company, the SEC also has additional disclosures that are required in publicly filed financial statements.
But the commission's rate-making treatment on ARO costs can be described in a footnote very successfully in an audited financial statement, can it not?
Yes, for regulated utilities, there would be a footnote typically titled Regulatory Assets and Liabilities, and within there'd be a description of regulatory assets and liabilities recognized.
And that could explain the rate-making treatment for the differential that may be different from GAAP or FERC. Is that correct?
That's correct.
I have no further questions.
All right. Attorney General's office?
No questions. Thank you.
All right. Any additional cross-examination for this witness? All right. Redirect for the witness.
Yes, thank you, Chair Mitchell. Mr. Riley, received some questions from Mr. Grantmeyer about ARO accounting. And in previous testimony, we've heard about how the commission ordered ARO accounting, in this instance, the lines of applications and orders related to coal ash recovery, and then the recognition in 2018 by the commission that the company had no choice in the matter but to use ARO accounting. But can you explain the process for creating AROs, their requirements, and how it fits into the rate-making process?
Certainly. So bear with me in terms of the discussion of journal entries. But when you step back, what FAS 143 required, and then FAS 143 became ASC 410, it required that for legal retirement obligations, that companies must recognize those legal retirement obligations on their books and records. Prior to the issuance of FAS 143, there was diversity in practice in terms of companies recognizing or not recognizing legal retirement obligations. What the standard requires is that to the extent that there's a legal retirement obligation identified, a company will look to estimate what that retirement obligation is. And that estimate will be based on what a third party would incur in terms of costs to perform that retirement obligation activity for the company. The company would then present value those future retirement expenditures back to today's dollars and would recognize an obligation called an asset retirement obligation with an offsetting, and that's a credit, with an offsetting debit and asset retirement cost. Now, I think it's important to note that that asset retirement cost is not a separate asset of the company, but rather it's part of the operating asset, the long-lived asset, which is associated with. So in this case, it'd be the coal plants. And FASB was very specific on this point. They viewed that the the asset retirement obligation was integral to or a prerequisite for operating the long-lived asset. It was not a separate asset, but it was part of the overall long-lived asset. And then what would happen is that asset retirement cost, the asset, would be amortized over the life of the operating asset. The obligation, which I mentioned, which is present valued, would be accreted into the future. Accretion expense would be incurred every year to increase the obligation as you came closer and closer to those retirement activities. Both of those items would be reflected as expense, annual expense, a period charge within a company's financial statements. Separately, what has to happen is then a company would, if it's a rate-regulated entity, would make a determination as to whether or not those expenses are recoverable from ratepayers in the future. And the standard there is it probable of recovery from ratepayers in the future? Not guaranteed, but probable, which is generally 75, 80% in terms of a percentage. If it's deemed probable, then it would result in the company recognizing a regulatory asset and reversing the expense that was recognized under the ARO accounting for that year. And so you would end up with a regulatory asset. That regulatory asset would only get reversed when that amount was actually recovered from ratepayers. I'd like to, I'm sorry, you were on mute. Maybe I just want to make one clarifying point. At the time a company estimates its ARO or its asset retirement obligation, that represents an estimate of what a third party will incur to perform those retirement activities, even if the company will perform them on its own. So it has to be in the eyes of a third party. Separately, it's an estimate, and estimates can change over time based on changes in facts and circumstances, changes in technology. In addition, there can be multiple scenarios in terms of how retirement activities are performed. If that was the case, then a utility would apply a probabilistic model to come up with that asset retirement obligation. But the key point there is that overall, this asset retirement obligation is an estimate. And to the extent that the estimate changes, it would be recognized in that period as a change in estimate.
Okay, so it would be fairly typical for those estimates to change over time. Is that correct?
Yes, excuse me.
Is that yes?
Yes, yes.
And you talked about when the initial retirement cost is established and its connection to the facilities. And you've heard testimony or the standard of used and useful. Can you talk about how in creating or establishing that initial retirement cost, how that can relate to the idea of used and useful?
I would object. I don't remember any cross-examination on the terms used and useful. This Bill Grantmeyer.
The cross-examination by Mr. Grantmeyer was about ARO accounting. I'm talking about a facet of ARO accounting, and in particular, the initial retirement cost. And so I'm asking a question that is very related to cross. It just wasn't, the three words used and useful weren't included in your cross.
All right, Mr. Heslin, I'm going to overrule the objection. I'll allow the question to proceed, but please stick to redirect.
Yes, Chair Mitchell.
So maybe going back to what I said earlier, that the FASB looked at that asset retirement cost as being integral to the operating asset itself. In this case, the coal plant. The coal plant was deemed used and useful and was a recoverable cost from ratepayers. The one point that I would like to highlight, and it was just mentioned in my testimony, that ASC 410 is typically excluded from rate making. The reason for that is because in many cases, there hasn't been a cash outlay associated with the asset retirement obligation. So in this case, although the asset retirement cost has been recognized, there hasn't been a cash outlay as yet related to the retirement obligation efforts. And therefore, what I typically see across the country is that asset retirement cost and obligation are excluded for purposes of rate base, and instead are recovered in the future as the company gets closer to its retirement activities or gets beyond its retirement activities.
Thank you, Mr. Riley. And kind of following up on that, Mr. Grantmeyer walked you through certain parts of your testimony where you state very clearly that you recognize the principle that accounting follows rate making. But I'd ask you to provide a little context for those statements in your testimony and why that applies here within the context of the coal ash expenses and costs that we're talking about.
Certainly. So it is a favorite phrase of ours in the utility world. And really what it's meant to say is that commissions have a lot of latitude in, obviously, in terms of setting rates. For purposes of financial reporting, what ASC 980 does, GAAP accounting, it recognizes the effects of how rates are established by a commission. Not the other way around. The accounting comes after rates are determined. And the consequences of that can be, as we talked about earlier, a deferral of expense, because that expense could be recovered in the future rather than as in the period that it's incurred. It could be recovered in the future from ratepayers, and therefore the accounting would defer the expense. Similarly, if a company were to recover monies ahead of incurring a cost, as is in the case of cost of removal, for example, it could result in establishing an obligation, a regulatory liability is what we call it, to be carried on the books of the financial statements. But it's an important point that for financial reporting purposes, the commission sets rates, and then for financial reporting purposes, you reflect the impact of those decisions in the financial statements of a company.
And I think you might have touched on it with that answer, but I just want to be clear. Mr. Grantmeyer asked you to turn to page 21 in your testimony when he was going through the series of questions about certain statements about ASC 410 in your testimony, and on lines 6 and 7 of page 21 of your pre-file rebuttal testimony or your rebuttal testimony. It states, however, ASC 410 acknowledges that many regulated entities recover asset retirement costs differently than how GAAP may recognize the related expense. Do you have any further context or explanation for that statement, or have you covered that?
Just to clarify that point, what we see at utilities across the country, really what's getting at here is that, as I talked about earlier, over time, that asset retirement cost will be depreciated and depreciation expense will be recognized. Similarly, the asset retirement obligation, because it has been present valued, must accrete over time up to the ultimate obligation that needs to be relieved. And so that accretion expense and that depreciation expense will be recognized in the financial statements of a company. To the extent that it's probable that that depreciation expense and accretion expense is probable of being recovered from ratepayers in the future, then that expense would be deferred and the company would recognize a regulatory asset for those costs.
And is that similar to what has happened here in this instance, or is it different?
It is similar. This is exactly how Duke has applied the accounting at DEC. And I would say it's in my experience working with utilities across the country, this is very consistent with what I see across the country.
And in addition, Mr. Grantmeyer, when he was walking you through the rate making statute, he highlighted that gap in FERC were not contained or included in the text of that statute. But to the extent that there are those are industry standards that apply to utilities such as DEC. Do you have an opinion on whether deviations from those standards in different jurisdictions could have an impact on companies or the industry as a whole?
Well, I haven't read what was referred to that the statute. It's not surprising to hear that it doesn't refer to GAP or FERC, because from my understanding and what I'm hearing, that relates to rate making and how rates would be established, which is completely, as I said before, is completely separate from financial reporting purposes. Financial reporting would be applied after the rate making is determined. Now, I'd point out that we've talked about deferral of expenses for future recovery. If for some reason that these costs were deemed not to be recoverable, then that would result in a charge by the company for disallowed costs. So that's the flip side to what we're talking about here for financial reporting purposes.
And you wouldn't be surprised to know that Rule 8-27, North Carolina Utilities Commission Rule 8-27 requires the FERC uniform system of accounts of utilities. But would you?
No, that would not surprise me.
And from an accounting perspective, is there a bright line rule that dictates whether an activity is always capitalized or always expensed? Or is the end purpose of that activity what governs the accounting?
I would object. I don't remember asking any of these questions about what's capitalized and what's not.
All right, Mr. Haslam, can you tie this to cross-examination of your witness?
Once again, it's just the general accounting principles that are inherent in the ARO. There's obviously been testimony before this about the ARO and those costs coming out of the ARO, is whether they were expenses or some other category. And so these are redirect related to that facet of the testimony.
All right, Mr. Haslam, I'm going to overrule the objection. I'm going to allow the question to proceed, but I'm going to ask you one more time. Let's stick to redirect here.
Thank you, Chair.
Question in the context of ARO accounting, I would say it is unique. If I go back to my initial statement, when a company makes an estimate of a legal retirement obligation, it records an asset retirement obligation and an associated asset retirement cost. Again, that's an asset. You say, what is that asset comprised of? It's comprised of the estimate of future retirement activities associated with legally retiring that asset, whatever that means in that particular context. And so it's retirement activities in this case that are getting capitalized on a present value basis. So it's very unique as it relates to ASC 410 as compared to other GAAP that you might point to in terms of capitalization of property, plant, and equipment versus recognition of period costs. AC 410 is very specific in terms of how that asset retirement cost is built up.
Thank you, Mr. Riley. Mitchell, I have no further redirect at this time.
All right, questions from commissioners, beginning with Commissioner Brown Bland.
I don't have any questions.
All right, Commissioner Gray,
No questions.
Commissioner Clodfelter.
Nothing.
Okay. Commissioner Duffley,
No questions.
Commissioner Hughes.
Yes, just a clarification question. In your testimony, you talk a lot about best practices or practices you've seen across the country. I realize there's a lot of unique things going on here, but I just wanted to get a better understanding of how what's being talked about in North Carolina relates to both the accounting standards and what you see in other jurisdictions. I think what the public staff is proposing in a lot of ways with this equitable sharing is not occurring through an accounting treatment, but it's occurring through a rate making treatment with the assignment of a rate of return. And I just want to clarify that is what the public staff has talked about by looking at a future net present value and coming up with some sort of net present value of option 1 versus option 2. I'm not sure if you've looked at the economic analysis that public staff is requiring, but that's what I think that they're requiring. That's what they're proposing is option 1 versus option 2, and they get to their equitable sharing by comparing option 2 to option 1. But I think both of those options are economic analyses. They're not accounting treatment. So I'm trying to understand from an accountant's perspective, an ARO accounting perspective, can what the public staff is proposing be done without involving any kind of changed accounting? In other words, if the rate of return is set at a rate making period and that's known and that's moving forward, that all can be done within the confines of this ARO accounting standards, can it not? I know that was a long question. I'm happy to try to clarify it.
No, sir, I understand your question. Maybe I can try to respond, and then if I don't fully respond, you can follow up with a question. I understand your point around an economic analysis. If I were to step back as just an accountant thinking about this situation, as I think about any sort of recovery of cost, recovery of an asset, what I have to ask myself is, based on the accounting standards, is the company receiving full recovery of its costs? And by the way, if it's actually been out-of-pocket cash, getting a return, an allowed return as well on those costs, or is it something less? If it's receiving something less than a full return, a full recovery of and on costs that it has expended, then that would be viewed as being a disallowance. It can be an explicit disallowance or an implicit disallowance. And there are accounting standards that drive disallowances. So to the extent that a utility expends $1,000, for example, and is not allowed recovery on and of that $1,000, say the regulator determines that it will only allow recovery of $800 over a 5-year period, or say the utility is only allowed recovery of $1,000 but over a 5-year period. In both of those situations, an auditor would look at that and say, there's been an explicit or an implicit disallowance of costs. And that disallowance would be recognized immediately as opposed to over time. So there are accounting consequences associated with, call it an economic analysis, that results in a sharing of costs. That sharing, what the shareholder is absorbing, gets recognized immediately.
So with that explanation, what do accountants use as the default rate of return for calculating the disallowance? Isn't that set at rate setting time, or is there some sort of standard that you use for the default?
It can depend on the situation, but in the case of a company using its general funds, in this case, say for coal ash remediation, generally it'd be the weighted average cost of capital.
So that's what you would use, and that's the default rate.
That's correct.
Okay. And then if I can just understand it, this is a basic question. When you were talking about a number of times, I think I heard that you said that these ARO assets are very difficult to map over to physical assets. Is that true? I mean, if there's an asset on the book that is actually a physical asset that I can go see versus an ARO asset, that if I followed the way those were treated, I would see a number of differences. I mean, the ARO asset gets on the books before the physical asset's even there, before a dollar's even been spent. Is that correct? But that wouldn't happen with the physical asset?
I apologize if I was unclear earlier. So you have the creation of an actual physical asset. Well, let's use the coal plant in this example. The coal plant is built. You have a physical asset. The company has determined that there is a legal retirement obligation driven by CAMA, driven by CCR, and therefore it must recognize an asset retirement obligation and an associated asset retirement cost, an asset. The FASB the Financial Accounting Standards Board does not look at that asset retirement cost as being some separate intangible asset. It's not a separate asset, but rather that asset retirement cost is part of the coal facility itself. It's part of that operating long-lived asset. And that asset retirement cost would be amortized over the life of that coal asset. So depending on what asset retirement obligation you're talking about, you're going to have different asset retirement costs that are mapped to different assets that created that legal retirement obligation.
But from that standpoint, if I'm looking at a coal plant, I'll see a lot of physical things made out of concrete and steel. They will be getting a rate of return on that asset being shown up. Then over here to the left, I have to visualize a bunch of future trucks harding ash away, and that's this intangible asset. That part of the asset has a value, but doesn't exist yet. There's not a truck moving forward. Does that part of the asset, is that earning a return the same that the physical parts of the asset are earning a return?
It's a good question, and that gets into my point around the cash. At the time that asset retirement cost is recognized, the utility is not out-of-pocket cash. In your words, the trucks haven't started coming in to remove those assets. And so as a result, that asset retirement cost and obligation for rate-making purposes are typically excluded from rate base. And if you follow Duke's accounting, what happens is, bear with me, that asset retirement cost is depreciated, that asset retirement obligation is accreted, expense is recognized on an annual basis. Duke takes the position that it's probable that those expenses are recoverable in the future from ratepayers. So it reverses that expense and records a regulatory asset. Now, at that point, it's still not out-of-pocket cash. So they record the regulatory asset, but they do not earn a return on that regulatory asset at a future point in time, when they start expending monies, now cash is actually starting to flow. They reverse that regulatory asset and record a regulatory asset. I think they call it a spent regulatory asset, to designate amounts recoverable from ratepayers for which they are out-of-pocket cash. They have used shareholder funds, and as a result, should earn a return on that spent regulatory asset. I hope that answers your question.
I have it now. And you wrote some of that in your testimony, and you answered some of that before. I just needed to hear it 3 times. Thank you. No further questions.
All right, Commissioner McKissick.
Just 1 or 2 brief questions. Mr. Riley, with Price Waterhouse, you obviously provide similar or comparable services as to what you're doing in this case to utilities across the country. Is that correct?
That is correct.
So let me ask you this, because we've been focused so much on what Duke is doing or what the way they've handled things. In other jurisdictions that had the used coal as a way of generating electricity, they had the coal ash ponds or impoundments. In those other jurisdictions that you are familiar with, are they wrestling with these same types of issues at this time in terms of accounting in the way they're establishing things?
In my opinion, no. No.
They're not in other places. What did they do in other jurisdictions to handle things differently in terms of potentially treating the coal generation facilities in a way to know that when they came to their end and they had these impoundments to deal with, to go ahead and put aside reserves for addressing it?
Generally speaking, it's how I just described it a moment ago, where generally around the time that CCR was issued, those asset retirement obligations and related asset retirement costs were recognized. They followed asset retirement obligation accounting, depreciating and accreting the asset and liability, deferring the expense, and then regulators in a particular jurisdiction, really in the context of setting rates for that jurisdiction, had to decide at what point do they allow recovery of those expenses over what period of time.
Thank you. I don't have any further questions.
Mr. Riley, I have one question for you. In response to questions from Commissioner Hughes, you indicated that if there is a disallowance, whether it be implicit or explicit, that disallowance is recognized immediately and not over time. Did I understand your testimony correctly?
That's correct.
Okay, and so can you then sort of, so then what happens if the disallowance is recognized immediately? What is the significance to the company? Help me understand sort of the rest of the situation.
Sure. Let me go back to my example, which was, say there's $1,000 asset and a commission chooses to allow only recovery of $800 of that asset over a 5-year period. So that translates into, or we'll make it a 4-year period, make the math easy. So instead of recovering $250 a year, they're going to recover $200 a year. What I'm getting at related to the disallowance and the immediate recognition of that loss is that GAAP does not want to defer that loss. It's a known loss. You're going to not recover $200. So why defer that loss and recognize it evenly over a 4-year period? It needs to be recognized today. Now, the impact of that would be a charge to the financial statements of the utility, and it would impact the company's net income in that period. Now, I'd also say, just qualitatively thinking about it as a person that works in the utility sector, from the financial side, to the extent that there's a disallowance that raises concerns related to regulatory uncertainty, and that creates concerns around credit and other potential issues associated with the company that can obviously impact company's cost of capital.
All right, thank you, Mr. Riley. All right, questions on commissioners' questions, beginning with the public staff.
Yes, this is Bill Grantmeyer again on Commissioner Yu's questions. Has DEC in this case proposed to include in rate base any portion of the balance of the asset retirement cost asset?
I don't believe so, sir, but I would say that that's more of a question for the company to confirm.
Are you aware that DEC is trying to include in rate base only a portion of the deferral of depreciation and accretion expense?
I think that they're looking to include the spent regulatory asset that I mentioned earlier.
Thank you. That's all I have.
All right, at this point, we are going to.
Chair Mitchell, I have one question on.
Mr. Haslam,
Oh, you can take. I'm sorry.
Oh, let's see. Yeah, we're gonna go ahead and take our break now for lunch. We'll go off the record. We're gonna go back on we will be back on at 1:30.
Thank you, Chair.
All right, Joanne, if you would, give me the signal. Okay. All right. Let's go back on the record, please. We are on questions on commissioners' questions for Mr. Riley. Mr. Grantmeyer had just finished his questions. Let me check one more time to see if any other intervening parties have questions on commissioners' questions for the witness. All right, hearing none. Mr. Heslin?
None.
Oh, Ms. Townsend, did you?
I was just saying no questions from the Attorney General's office.
Okay, thank you, Ms. Townsend. All right, Mr. Heslin, you're up.
Thank you, Chair Mitchell. Mr. Riley, Commissioner McKissick asked you whether other states were wrestling with these coal ash recovery issues, and you said no. In your observations, how are other jurisdictions handling coal ash cost recovery?
In general, what I observe is that they have not followed cost of removal accounting. What they followed is just traditional ARO accounting, similar to how Mr. Doss described their ARO accounting at DEC. To the extent that expenditures are made, companies are recording regulatory assets and earning a return on unrecovered regulatory assets. I think that's in general what I'm seeing.
Are you aware of any jurisdictions that have approved or adopted an equitable sharing theory with significant disallowances such as that proposed by the—
No, I'm not aware.
And based on your review of coal ash recovery decisions across the jurisdictions, why have these other jurisdictions not wrestled with this coal ash accounting ARO issue?
I would respond by saying that clearly these are costs that need to be dealt with, and commissions are looking at over what period will they be recovered from ratepayers, and in general, you see them being recovered more towards the retirement activities occurring. So in other words, you're not recovering it through cost of removal in advance, but rather in later periods. So it's more of a timing of recovery question for commissions as opposed to whether costs should be recovered.
And are the other jurisdictions allowing recovery of and on these coal ash costs?
We haven't seen, and I mentioned disallowances earlier, you haven't seen disallowances in this area, so the answer to that is yes.
And Chair Mitchell asked you questions dealing with the accounting perspective, potential regulatory disallowances. If the commission were to adopt the public staff's equitable sharing theory, which it denied in the prior DEC rate case, but in this case disallowed billions of dollars of recovery in coal ash costs, in your opinion, based on your experience and observations, what would be the perception of and the impact to the company?
Well, maybe we can start with the impact to the company financially. Obviously, there would be as I talked about earlier, a charge to earnings immediately in the income statement, and that would flow through to a significant reduction in equity of the company. Ultimately, the strength of the financial position of the company would be severely impacted, given that dollar size or the magnitude of that level of disallowance. In terms of perception, you have to think about it in terms of investors. Investors are comparing regulated utilities across the country. They have choices to make in terms of who they invest in, and they compare one utility versus another, and in terms of perceived risk. So the question investors would ask is the regulatory compact in North Carolina working? Is there greater risk in North Carolina as compared to other utilities elsewhere in the United States? And with that level of a disallowance, it's reasonable to assume that they would perceive a greater level of risk. And as a result, if they were to invest in Duke, they would expect a higher level of return. So all things being equal, they would expect a higher level from Duke than from others. The impact of that is that would increase the overall cost of capital of Duke, which when you think about rate-making theory, that ultimately would result in increased rates to North Carolina customers.
Chair Mitchell, I have no further questions.
All right, I actually have one additional question for the witness. When you, just so that we are all clear, when you say cost of removal accounting, can you explain exactly what you mean by that?
Certainly, and sorry it was unclear. Cost of removal accounting is a mechanism that is employed by regulators to allow for recovery of retirements in advance of them occurring. So it's just a matter of being able to build up a reserve to be able to pay for the retirement when it happens. And you typically see, and I think witness Doss talked about this related to non-legal retirement obligations. The point around cost of removal is that you're recovering costs in advance of the actual expenditures from ratepayers, i.e. building up a reserve. And typically what you see as it relates to the AROs that we're talking about is that they're typically recovered after the expenditures occur from ratepayers as opposed to recovering it in advance.
All right, thank you, Mr. Riley. Any questions on my question just asked of Mr. Riley? And I actually see Commissioner Duffley with her hand raised, so she must have an additional question for the witness as well. So I'll let Duffley proceed, and then we'll take questions on my question and Duffley's questions.
Thank you, Chair Mitchell. I just would like to clarify the record with this question. So you mentioned that the disallowance is recognized immediately, and then I thought I heard a response that could be billions of dollars, but is the disallowance just related? So let's say hypothetically there was a disallowance in this case. The full recognition would only be for the cost sought in this case. It would not be for the entire estimated ARO, correct?
I'll try to answer your question with an example. If the utility were in need to recover $1,000, going back to my earlier example, to recover $1,000 asset, and the commission were to conclude that it could only recover $800 of that $1,000 asset, and say they said they could recover it over a 4-year period with a return, then in that case, the disallowance in my example would be $200.
Okay, I understand that. Let's just use hypothetical numbers. Let's say that the estimated asset retirement obligation is $1 billion, but the utility comes in for a rate case as they spend, deferral and spend, and let's say in case number 1, they come in and seek $500 million. And the regulatory agency disallowed 50% of that 500 million. The company's then not required to recognize a full loss on that $1 billion. It would just have to immediately recognize the disallowance of $250 million. Is that correct?
Excluding considerations of return, the immediate disallowance, the explicit disallowance in your example would be $250 million. I think then what the company would need to assess is it exposed to non-recovery of the remaining $500 million? What caused the $250 million charge on the first $500 million? So it would have to consider the potential ripple effect on the remaining balance as well.
Okay, but that would be in the context of their credit metrics versus accounting?
It's an accounting consideration. So if they needed to recover $1 billion, they were only going in for the first $500 million, and there was an order to say share the first 500 million, 250 and 250, the company would need to say, is it probable that we'll recover the remaining 500 million? Or do we think it's likely that we will have a charge? Actually, is it probable that we will incur an additional disallowance on the remaining $500 million? In which case, if it concluded that it was probable that it would also have a disallowance on the second $500 million, it would also have to accelerate that charge as well.
At that point of the first disallowance.
That's correct.
Okay, thank you for that explanation.
Chair Mitchell, before you go, I have a question based on these questions too.
All right, you may proceed, Commissioner Hughes.
Yes, Mr. Riley, you've referred to the word disallowance a number of different times, and you've used an example of a $1,000. From what I understand here, the quote disallowance that the public staff is requesting, again, is a net present value disallowance. So it's a disallowance of a net present value in some cases over 25 years. So what from I can see on a cash flow diagram that they've presented is, they're disallowing amounts way into the future. And I'm just curious, again, to your example of it being shown right away. You gave an example of 500 million and 250 million is disallowed. Could you just say how it would work mathematically if it instead was 500 million was sought after and 500 million was granted, but over a period of time that caused a net present value disallowance? Because that's just way into the future, and I'm having a hard time wrapping my head around what would actually show up today. Does that make sense?
Yes, it does. I'll try to answer your question. So in your example, if the company is seeking $500 million in recovery and they're granted $500 million in recovery, except if the company is out of pocket cash today, $500 million, and they're not going to recover that for, say, a period of time, call it 25 years, they have used shareholder monies today, and shareholders expect a return on the use of their funds. So to the extent that the commission were to only grant recovery over a 25-year period, $500 million, in present value dollars, it's something less than $500 million.
Yep.
And what the accounting would require is for the company to assume or to assess what return would it have expected to get on those dollars. And I would have expected weighted average cost of capital. They would present value those dollars back to today's dollars to today. Using your example, say that discounts back to $400 million. They would take a charge of $100 million for that implied disallowance in accordance with the accounting standard. So in effect, because they're not getting a return on their money, that has to be recognized today as a charge.
So what you're saying is the net present value of the difference between the assumed return by standard accounting has to be calculated and charged off in the next calendar year.
That's right. In other words, if the commission were to allow a recovery of, but not on, assets that were the result of expenditures, there's an accounting consequence for the conclusion that they should not get a return on expended funds. And that's called an implied disallowance.
So, but figuring out the amount of that disallowance, then you have to again have the default, and you're saying that you would use a weighted average capital. Is that in the discretion of the company or the audit firm to decide what is the default for calculating that net present value? Because when you're talking about net present value, people are throwing around all different types of discount factors.
No, there are specific accounting standards on exactly how that accounting would work. And so the company, it's the company's books and records would apply, and forgive me, I don't remember the ASC reference, but it's the accounting standard number 90, FASB 90. The company would apply that to calculate the disallowance. So it's specific right in the accounting standard.
And does that, what did you say that was again, that accounting standard? Could you repeat that?
It's SFAS 90, I believe.
Thank you.
All right, thanks, Commissioner Hughes.
No further questions.
I see Commissioner McKissick has a question.
And it's simply this. I mean, I raised the question earlier about what other utilities were doing in terms of addressing issues similar or comparable to this, and whether they had, how they'd addressed it from an accounting perspective. The thing I'm curious in knowing is simply this. In light of the history of what was going on with coal ash and the ability to know that these facilities would have to be retired at some point, we later see the CRR rule being adopted. I mean, what exactly can you tell me other utilities are doing that did not do, that perhaps was not wise in hindsight?
I guess my answer to that question would be that I don't see Duke doing things that are different than other utilities were doing. Every jurisdiction, regulators are dealing with rates in an overall context in terms of managing current rates versus future rates, dealing with known costs, dealing with estimates, dealing with things currently versus pushing them off into the future, depending on how questionable certain estimates are. I would say that I don't see Duke doing things differently than what I've seen elsewhere.
And at what point in time were most of these entities beginning to, handle their accounting in a way that adequately would allow them to accumulate funds to have addressed the coal ash impoundment issues, in advance of the way we're approaching it here in North Carolina?
Well, in terms of the accounting, essentially utilities really didn't recognize their asset retirement obligations until CCR came out. York HAMA came out slightly before CCR, so you being Duke started to make their estimates of its asset retirement obligations at that time. And then, as I mentioned, generally speaking, utilities were deferring the expense that was being recognized as a period expense, the depreciation and the accretion, to be recovered in the future. And that recovery period was generally after expenditures were being made for utilities.
Okay. And are you familiar with the estimates that Duke obtained as it related to retirement of their coal generating assets?
In terms of the specifics of the calculation, no, I haven't reviewed those estimates.
You've not. So you're familiar with them in general in terms of what the total projected dollar value would have been, I take it. Is that correct?
Correct.
And were other utilities basically taking these issues into account significantly in advance of the adoption of CRR? I mean, from what I've read, they were.
In terms of the recognition of the obligation,
mm-hmm.
no, No, the obligations were generally recognized as a result of CCR.
Okay. So you were not saying nationally recognition of what those potentially contingent liabilities would be, for lack of a better way of saying it, in advance of the CRR's adoption.
That's correct. To the extent that utilities did recognize the liability prior to CCR, it was typically a very minor amount, and it was increased significantly at CCR.
And based upon what was going on in terms of coal ash and in terms of groundwater contamination or the potential for it, do you think that it would have been wise for Duke or for other utilities to have gone ahead and established those reserves in advance of the adoption of CRR?
And when you say reserves, are you talking financial liabilities or collecting cash in advance?
Well, beginning to collect cash in advance and likewise recognizing, for lack of a better way of putting it, the contingent liabilities that would have been associated either with the retirement of those coal generating facilities or based upon the potential for, groundwater contamination, which obviously there was a record and history of it occurring, perhaps not as expansive and pervasive as it was, but it was out there. I mean, at some point you have to say, if you're aware that these problems are out there, they're existing, they're occurring, at one point, do you sit back and say, hey, it's something we need to address, we need to be prepared for it, and we need to go ahead and either address it in terms of it being a contingent liability or in terms of creating adequate reserves to address it?
I would answer your questions by saying that on the accounting side, generally speaking, the utilities that I'm aware of did not really establish their asset retirement obligations until those CCR rules came out. Prior to that, it was very difficult to make that estimate. And really, it was CCR that triggered that estimate of the recognition of the significant retirement obligations. In terms of recovering cash in advance, and this is just my personal opinion, I think it's a matter of not having very specific estimates in terms of what those costs would be and when they would be incurred. And so as a result, they were not included in depreciation rates to be recovered in advance from customers.
Okay. And I think you said Price Waterhouse was not the auditor for Duke.
That's correct. The auditor,
and I guess the thing I'm trying to determine, and this has been something I've wrestled with for quite some time, and that's simply this: if I'm a utility and I'm out there and I'm aware that there are potential issues or problems, or if you're any other corporation, there are management team should be able to identify and be aware of things that are, for lack of a better way of putting it, in a more traditional sense, outside of the utility segment, contingent liabilities or issues or problems that are identified, which you attach some cost to, and which are actually revealed in your audits and in your financials because, it's a duty to disclose it, particularly if it's a publicly traded company. So the thing I'm trying to wrestle with is at what point in time kind of the utilities that are out there conducting business today really became aware of what they were wrestling with and dealing with to be able to address it and where it would have been reasonably and responsible to do it. And I wonder if it was before the adoption of CRR, maybe CCR provided a framework, gave them a basis for going out and getting the estimates done, and coming up with policies to address it, but would there have been enough awareness prior to that time to have reasonably taken action? And I refuse, I mean, I know it's a bit of a long question and got the acronym abbreviations a little bit twisted there, but help me out with that.
Sure. I would respond by saying that companies have specific footnotes that talk about environmental exposure, contingent liabilities. Public company filings have what's called an MD&A that talk about matters that the company is looking at in the future that could have an impact on the company. So prior to the issuance of CCR, it took years for those rules to come into effect. Companies in general in the utility sector were talking about CCR and the potential impact that it would have on the companies. And they had to, they talk, in general, they would talk about how that those rules were evolving up to them becoming formal and final. At the time they became formal and final is when the accounting entries happened. Prior to that, utilities were talking about the potential impact on utilities across the sector. But that doesn't necessarily mean that they had very hard numbers that they could point to say, we should start collecting this now. So I'm differentiating rate making and disclosures as well as financial accounting.
Testimony. And I think you've addressed the things that were perhaps in the back of my mind and perhaps the
Mr. McKissick, I didn't
yes.
have the beginning of your question there. You were on mute.
Oh, I'm sorry. Now, I understand what you're here to testify about, and perhaps some of the other questions that I have in the back of my mind that would help me clarify my thoughts about some of these issues going to be addressed by other witnesses that I think are going to be coming up shortly. So thank you.
You're welcome.
All right, let's go back to questions on commissioners' questions. Let's start with the public staff.
Yes, Bill Grantmeyer, Mr. Riley, you were asked questions by Commissioner Duffley and Commissioner Hughes, and you were talking about potential write-offs. I think you used the word billions of dollars. And then there were some examples where it was less than that. But aren't you aware that in this case, the difference between, based on Public Staff Exhibit 79, which is Public Staff DOS Spanos Rebuttal Cross-Examination Exhibit number 4, that the real differential in total dollars between what the public staff says they should recover, which is $262 million, and what Duke Carolinas wants to recover, being $430 million, that's only $168 million differential rather than the billions that you were discussing. Would you agree with that?
I don't have that exhibit in front of me here, but I think the billions was a hypothetical.
And also, you said if Duke gets an adverse ruling in this case, they may have to write off some stuff in the future. Would it only apply just to the dollars in this case that we're discussing in this case, the deferral amounts for the last 2 years?
As I mentioned earlier, to the extent that there is a disallowance in this case, the company would also need to make an assessment as to whether or not there are other disallowances that are now probable as a result of a determination like that in this case.
Well, should Duke Carolinas decide to appeal that, that would indicate that they think that future disallowances are not probable because the commission erred, and therefore they would not have to do a write-off, would they?
I can't testify as to what they think. They would have to go through that thought process as to whether or not it is probable.
Thank you.
All right, Ms. Townsend.
No further questions.
All right, thank you, Mr. Grantmeyer. Ms. Townsend, anything from the Attorney General's office? Or Ms. Force?
Yes, I have a couple of questions for Mr. Riley. Mr. Riley and Margaret Force. To follow up on the questions that you were asked by, well, several commissioners, but last Commissioner McKissick, you've talked about shareholder dollars being disallowed if a commission were to determine that some of the dollars had already been accumulated in the past for the company. Would that be something that you would consider shareholder dollars being spent? Is that a disallowance in that case, or is that just not?
I apologize. I'm a little confused on your question. Are you saying that they would have, if they've recovered monies already from ratepayers?
Well, here, I'll give you a hypothetical. If you have a situation where a company has included an increment in rates to recover, to put aside some of the cost of dismantling the plants involved, and then at some point that situation becomes a legal asset retirement obligation. Do you, when you identify the amount of the obligation, how do you treat the amount that has been accumulated in the past where it was not at that point yet a legal obligation?
So the amount recovered in advance from ratepayers would be accumulated as a regulatory liability. In other words, if those monies were not spent as intended, then it would have to be refunded to ratepayers. So to the extent that the company has a retirement obligation and it spends money on those retirement activities, then it would relieve the obligation. It would also be relieving that regulatory liability because it would no longer have to refund those money to ratepayers.
So for accounting purposes, I think what you're saying is it should already be reflected on the books as a liability because it's been accumulating. Is that right?
I would agree.
I see. Okay, and could you tell me if you have a non-regulated entity that, including a utility that's not regulated, that, for instance, has a coal plant that bids into a power exchange, and the rules came out that indicated that the cost of closure of those coal ash impoundments is going to be more than was previously anticipated. Is that something that, for accounting purposes, would be written off?
No, you would not write it off. What you would do is recognize that change at the time it happens. And it's, I used the phrase earlier, it's a change in estimate. And so you would revise your obligation estimate, record an associated asset retirement cost. So you would add to your asset retirement cost and then amortize that asset retirement cost over the remaining life of the related asset.
I see. But in terms of how that would be handled, then, since it doesn't have regulated rates, it would be perhaps written off because the entity doesn't want to carry that going forward on its books since it's a known obligation.
I think what you're thinking of, and tell me if I'm wrong, is at generally accepted accounting principles require companies to evaluate whether or not an asset is impaired. Now, this is an unregulated business, and so there are very specific rules around evaluating assets for impairment, but it would have to be evaluated, the future cash flows that would be generated from that facility, undiscounted, would be compared to the carrying value of those assets. And to the extent that the assets on the books were greater than the gross cash flows to be recovered from that facility through sales, then you would have an impairment to recognize.
Okay. I appreciate the terminology. Thank you. I don't have any other questions.
All right, any other questions from interveners on commissioners' questions? All right, Mr. Heslin.
Yes, just a few, Chair Mitchell. This refers to Commissioner Duffley's questions, Mr. Riley, and a little bit to what Mr. Grandmeyer tried to walk you through. But in the event, in this case, were the commission to adopt and approve the public staff's proposal of equitable sharing, and in doing so, use that as the justification to disallow, 50% of the coal ash costs in this case for the amounts that are requested in this case. Can you explain again what the impact would be on the estimated costs in the future from an accounting perspective, and how the company would have to look at that and treat it?
So as I tried to state earlier, the company has to evaluate if there's a disallowance, and if it's probable that there's a disallowance, and as a result of a rate order, you may have a explicit disallowance. Or we also talked about with Commissioner Hughes how it could be an implicit disallowance where you're recovering of but not on expended amounts. I also tried to indicate that it's a disallowance assessment is not specific to just the costs that are in question related to this particular rate case, but rather the company would have to evaluate based on this particular accounting or rate order that they're receiving, what are the implications to the company overall? And does it create a situation where it's not probable that other amounts that have been recognized will not be recovered from ratepayers? And if that's the case, then they would also have to take a charge for those costs as well.
So in understanding, we were talking a little bit hypothetically, and we weren't talking precise numbers, and that you're not familiar with the exact numbers in this case. Those future costs and those future impacts, is that where perhaps the billions was coming from in your testimony and responses to questions?
I believe so, yes.
And then Commissioner McKissick asked questions about what the company may have done prior to the legal obligations that arose in North Carolina with the camera and then the CCR rules. And you talked about with Commissioner McKissick the idea of, or the theory of building up a cash reserve, perhaps in depreciation rates prior to the legal obligations and the creation of those AROs. But what is the process for a company to do something like that, to build up a cash reserves in its depreciation? And what does it have to know at that time to do so, and ultimately to recover that cash from customers in advance?
Well, I think Witness Spanos talked about that. My observation is that generally speaking, you have to have an ability to have a good estimate of what those costs are and when they will be incurred in order to get them to convince a regulator to include them in your depreciation rates. To the extent that they are included in depreciation rates, you'll be building up a reserve which will be reflected in the accumulated depreciation, but really what it represents, and for financial statement purposes, it's reclassified to that accumulated depreciation balance is reclassified to a regulatory liability, as I mentioned earlier, whereby to the extent that those expenditures, the retirement expenditures, do not occur, then those amounts would be refunded back to ratepayers. But it's really collecting money. It would be a situation where you'd be collecting money in advance from ratepayers for specific known costs.
And would you accept, as far as the CCR rule, subject to check, that came out in 2015?
Yes.
No further questions, Chairman.
All right, at this point, I will entertain motions from council.
Chair Mitchell, Duke Energy moves for admission the one exhibit, Riley rebuttal exhibit number 1 into evidence.
All right, Mr. Heslin, hearing no objection to your motion, it is allowed. All right, Mr. Riley, you've come to the end of your testimony. You may step down, sir. Thank you very much for being with us today.
Thank you.
All right, Duke, you may call your next witness. I assume you don't need a break in time at this point to get her ready.
You froze. I lost you at some point. You said that.
Okay,
thank
can
you
you?
for being with us today is where I lost you.
All right, can you hear me now?
I can.
Let's just say a little prayer that the internet service in the Dobbs building doesn't let us down. All right.
Chair Mitchell, I think we're ready.
You're ready to go. I just wanted to make sure you didn't need time to get your witness in. Look, I see her, so she's ready to go. All right, Ms. Bednarczyk, just for abundance of caution, let's go ahead and get you, affirm you one more time. Raise your right hand, please, ma'am. You affirm the testimony you're about to give shall be the truth, the whole truth, and nothing but the truth.
Yes.
All right, Mr. Marzo, you may proceed with your witness.
Thank you, Chair Mitchell. Ms. Bednarczyk, once again, would you please state your name and your business address for the record?
My name is Jessica L. Bednarczyk, and my business address is 400 South Tryon Street, Charlotte, North Carolina, 28202.
And again, by whom are you employed and in what capacity?
I'm employed by Duke Energy Business Services, LLC, and I am the Vice President of the Coal Combustion Products Operations, Maintenance, and Governance Organization.
Thank you. And did you cause to be pre-filed in this docket rebuttal testimony consisting of 60 pages?
Yes.
And do you have any changes or corrections that you need to make to your pre-filed rebuttal?
Yes.
Okay, and an errata identifying those changes to your rebuttal testimony has been filed with the commission. And if I asked you the same questions today, would your answers be the same as corrected by the errata?
Yes.
And did you also cause to be pre-filed Bednarczyk rebuttal exhibits 1, 2, 3, and 4 to your rebuttal testimony?
Yes.
And do you have any changes or corrections that you need to make to your pre-filed rebuttal exhibits?
No.
And for the record, portions of the testimony and exhibits are marked confidential. Is that correct?
Yes, that is correct.
Okay. And Ms. Bednarczyk, did you also cause to be pre-filed in this docket supplemental rebuttal testimony consisting of 5 pages?
Yes, I did.
And do you have any changes or corrections to your pre-filed supplemental rebuttal testimony?
No, I do not.
And if I ask you the same questions today, would your answers be the same?
Yeah. Yes, they would.
Okay. And finally, did you cause to be pre-filed 12 pages of supplemental testimony on August 28th, 2020 in response to Commission's order?
Yes, I did.
And do you have any changes or corrections to that pre-filed supplemental testimony?
No, I do not.
And if I asked you the same questions today, would your answers be the same?
Yes, they would.
And did you also cause for pre-filed Bednarczyk supplemental exhibits 1, 2, 3, and 4 to your supplemental testimony?
Yes, I did.
And I note for the record that a correction was filed to exhibit number 3 to that supplemental testimony. Is that correct?
Yes, that is correct.
And with that correction, do you have any other changes or corrections to your pre-filed supplemental exhibits?
No, I do not.
Chair Mitchell, at this time, I would move that Ms. Bednarczyk's pre-filed rebuttal testimony, her supplemental rebuttal testimony, and her supplemental testimony be entered into the records if given orally from the stand.
All right, Mr. Marzo, hearing no objection, Ms. Bednarsik's rebuttal, supplemental rebuttal, and supplemental testimonies will be entered into the record as if given orally from the stand.
And that Bendarsik rebuttal exhibits 1 through 4 to her rebuttal testimony be marked for identification and as indicated, confidential where appropriate.
All right, hearing no objection to that motion, her exhibits will be so marked with confidential designations as appropriate.
Thank you, Chair Mitchell.
And Mr. Marzo,
yeah.
just for purposes of the record, portions of her testimony that is confidential shall be so designated when copied into the record.
Thank you, Chair Mitchell. I'd also ask that Ms. Bendarsik's supplemental testimony be entered into the records if given orally from the stand today, and that Bendarsik's supplemental exhibits 1 through 4 be marked for identification.
Her supplemental exhibits will be marked for identification as they were when pre-filed.
Okay, thank you, Chair Mitchell. Ms. Bendarsik, did you prepare a summary of your rebuttal and supplemental testimony?
Yes, I did.
Okay, Chair Mitchell, that summary was provided to the commission and parties to these dockets as required by the commission's order. And I'd ask that the summary of Ms. Bendarsik be read into the record as if given orally here today.
All right, hearing no objection, Mr. Marzo, Ms. Bednarsik's summary will be copied into the record as if given orally from the stand.
Thank you, Chair Mitchell. Ms. Bendarsik is already available for cross-examination.
All right, I would note before we begin cross-examination of the witness that to the extent you need to, counsel, you anticipate asking questions that will elicit confidential information, you must alert me to that, and we will leave the video conference technology and join the telephone line that has been provided to you or will be provided to you shortly. Again, I will rely on you, counsel, to alert me when we get to that point in time. All right, with that, I believe public staff, you are up first.
Thank you, Chair Mitchell. This is Nadia Lohr with the public staff, and I will be asking Ms. Bendarsik questions related to groundwater extraction and treatment, permanent water supplies, and equitable sharing. And my colleague, Ms. Yost, will be asking questions related to the CHARA fulfillment fee, the Dan River excavation and transportation costs, and the Buck beneficiation project. And it's our understanding that the company does not object.
Yeah, that's correct, Chair Mitchell.
All right, you all may proceed.
Thanks. Good afternoon, Ms. Bednarzik.
Good afternoon.
In your rebuttal testimony on pages 48 through 50, you discuss Mr. Junas's proposed disallowance for the cost of groundwater extraction and treatment at Belews Creek. I'll give you a moment to get there.
Ms. Lohr, can you give me the page number again, please?
Yes, so I was referring to pages 48 through 50, but now I'll refer you directly to page 49.
I'm on page 49.
Okay. So on lines 4 through 6, you state that DE Carolinas would have installed extraction wells at Belews Creek in order to comply with CAMA, even without the sudden settlement agreements. And Ms. Bendarsik, that's because Belews Creek had exceedances at or beyond the compliance boundary at Belews Creek. Is that right?
That is correct.
And if the company did not have exceedances at or beyond the compliance boundary, neither CAMA nor the CCR rule would have required those extraction and treatment wells. Is that right?
So my understanding is that is because we had exceedances beyond the compliance boundary. That is why those extraction wells were installed.
Okay. And starting on page, we're still on page 49, on line 22, going through page 50. You state that an increase in measured exceedances does not suggest an increase in groundwater contamination at Belews Creek. Is that correct?
Yes, that is correct.
And Ms. Benarsic, groundwater flows over time, correct?
Yes, and each station and each site, depending upon geology, it flows at different rates, but relatively a slow rate, yes.
So when you sample groundwater at the same well over time, you're not just sampling the same water over and over again, is that right?
So it depends on when you do the sampling and the flow rate of that specific site. That is one of the reasons why you do take samples, whether it is a quarterly basis or a semi-annual basis, because the geology also depends upon the seasons and what is going on in geology as a whole.
Okay. So, but generally, would you agree that you're sampling essentially constituents that are flowing through and past the wells over time?
I would say generally, but also that's why you put groundwater monitor wells in to see what is in that area and whether or not the constituents are stable, because that will sometimes tell you that you have a stable plume, whether they're increasing or decreasing. And that is why you put in groundwater monitoring wells in order, once you've done the original assessment, and you do your assessment over a long time, sometimes it's many, many years, in order to determine really what is going on in the ground.
Okay. So if you continue to conduct groundwater monitoring, in those wells over a period of time, and you continue to see exceedances, would you agree that that's an indication that the contamination is continuing to spread?
So I would say not necessarily. It could mean that the contamination is stagnant and is not spreading. It could mean that it is spreading. So again, that is why you take multiple samples in order to determine what is going on in the groundwater. Each site is different. Each plume is different. So it could mean that it's spreading. It could mean that it's stable. That is why you're looking and evaluating, and you do not make determinations off of one groundwater monitoring event.
Thank you. Now, turning to page 51 of your testimony, lines 2 through 6, you state that the requirement for permanent alternative water supplies and water treatment systems exists even absent the existence of a 2L exceedance. But Ms. Benarsic, doesn't the company actually have 2L exceedances at or beyond the compliance boundary at each of its sites?
So, Ms. Laura, I think that the main difference is that the permanent water supply requirement in CAMA said that it did not tie the need to provide permanent water to homeowners based upon an exceedance at the homeowner's wells. So that is the nuance related to the requirement for permanent water. Typically, and this is something I discussed also last week, is if we saw a plume, if we saw something that was going towards a homeowner's and may get there sometime in the future, then of course we would have put that homeowner on a permanent water. But what we saw really at all of our locations in the Carolinas is that we're covered underneath CAMA, and the provision of permanent water supply is that groundwater was not flowing towards those homeowners, or if there were exceedances of the 2L standard at a homeowner's house, it was not attributed to coal ash constituents because of the way the groundwater was flowing. So I think that's the key nuance to be able to look at the permanent water provision. If you look at the words in CAMA itself or in House Bill 630, it clearly calls out that you do not have to show that the groundwater at the homeowners' homes was impacted by coal ash constituents. It didn't matter that the company would have to provide a permanent water solution to those homeowners.
Understood. Would you agree that the requirement to provide those water supplies to those homeowners was tied to the risk of that contamination eventually reaching those water supplies?
So I would say that I don't know exactly why the legislature added that in. I do know that there was a lot of discussion with the Department of Health and Human Services, Department of DEQ, Department of Environmental Quality, as to what was going on around the coal ash basins and what was a protective level. Starting in, I believe it was 2014, we did receptor studies and confirmed what we had seen prior to 2014, that groundwater was not going towards these homeowners and was not being impacted by coal ash constituents. So when the House Bill 630 passed, and I believe it was in the 2016 time period, we already had a lot of data actually working with the state agencies showing that coal ash constituents were not going towards homeowners, were not affecting homeowners' wells, but the legislature still determined that they needed to add this provision within House Bill 630. So that's my, I don't know why they did, but that's the history as I know it.
And in your opinion, not speculating as to what the legislature was thinking at the time, but in your opinion, is there a risk in the future of contamination from the coal ash impoundments reaching any nearby neighboring wells?
No, I do not believe that there is a risk in the groundwater models we have shown that we have developed. The groundwater data that was collected both by ourselves and by DEQ has not led to an indication that we are going to have a risk related to our homeowners or towards the homeowners surrounding our plants.
And that's your contention despite the continuing spread of contaminants from the coal ash impoundments?
So yes, because you have to look and see where the groundwater models are showing and how the groundwater is flowing. And Mr. Wells will be able to talk, we'll probably be able to talk about this a little bit more, but our groundwater models are showing that the groundwater flow, where things are going, and we are doing a groundwater corrective action program, because there is a couple locations where we'll be pulling the groundwater back inside the compliance boundary, but there are no homeowners in that area that are being affected adversely by groundwater, and the models are not showing that it's going to go there either.
Do you know whether background levels had been established and approved by DEQ prior to the requirement to provide permanent water supplies?
So specifically, background levels at each one of the locations was being evaluated, I do know, by DEQ during the 2014-2015 time period. Background levels that I do remember during that time period because I was the person that was actually implementing the provision of permanent water and talking to all the homeowners. So I do know in that time period, there was a lot of discussion on background, a lot of working with DEQ on what was background, what was not background. So it was something that had to come out of the agency. We were providing them a lot of data. When they actually kind of put the line in the sand and said, this is background, I don't know that date. But I do know in the 2015, 2016 time period, when the House Bill 630 was passed, is that background was, I don't know if I could say 100% established, but I do remember very clearly talking to DEQ at that time and understanding what is background and what the risk was to the homeowners.
Okay, we can move on. On pages 53 to 55 of your rebuttal testimony, you discuss the public staff's equitable sharing proposal. And on page 55 specifically, lines 5 through 9, you state that in the 2017 rate case, neither the public staff nor any intervener was able to quantify any discrete costs throughout the company's considerable history managing CCR that was deemed to be imprudent or connected to an imprudent action. And then you continue, the same is true in this case. Are you aware that the public staff's recommended equitable sharing adjustment is based on General Statute 62-133D, which does not require a showing of imprudence?
So I do not have the exact statutes memorized as to what is in there, but I do know that equitable sharing was discussed in the last case. And when we moved forward with what was presented this time around, we did take into account what had been ruled on by the commission in the previous case.
Okay. And on page 58 of your testimony, beginning on line 5, you state that before the CCR rule and CAMA, the company's operation of its CCR impoundments was consistent with existing federal and state law. Is that an accurate restatement of your testimony?
Yes.
Isn't it true that prior to CAMA and the CCR rule, the company's coal ash impoundments caused exceedances of the groundwater standards at or beyond the compliance boundary?
Yes, but I would also say that we were working with the state agencies. There was that 2011 policy memorandum that came out from NCDEQ that shows that the company was working with the regulators, trying to understand with these legacy, with these, not legacy, but with these past, these operating units that were utilized and have been historic operating units, in many cases still operating units. What do we need to do in order to move forward based upon the groundwater exceedances? So, so I would say, yes, we did have exceedances, but we were working with the state agencies in order to determine what are those next steps and what are the corrective actions that need to take place at these locations.
Well, isn't it also true that the state's 2L rules, which have been in effect since 1979, prohibit exceedances of groundwater standards?
So that is my understanding of 2L, but I have been working in North Carolina with, I had many years working on remediation sites, and where there were exceedances of 2L, this is what we did with the CCR sites is exactly the same that we've done at other sites. It's not very, though there is an exceedance, there is the, okay, this is something that's been going on based upon an operating unit, or in some cases like an underground storage tank. And so what do we do? How do we move forward with figuring out what are those steps that we need to take in order to manage the risk, address the risk, and address whatever is, whatever those next steps need to be. So what I have seen in my history of working in the state of North Carolina on remediation sites, specifically with groundwater cleanup, is that what we did in the CCR and around our CCR ponds is exactly the same that we do in other areas. We see that we have an issue. We see that we have an exceedance. We work with the regulators in order to determine what are those next steps that we need to do in order to manage the risk. First thing you want to do is, of course, manage risk to human health, and then also determine what are the appropriate steps you need to take next in order to address what is going on in the environment.
But it appears in this case that it took approximately 3 decades for the company to begin that process if they began working with DEQ around 2011. Is that right?
So I mentioned the 2011 policy memo as many years before that, and Mr. Wells knows a lot more about the history of our groundwater compliance in the company. So I would say that please ask him. He will be able to provide you a better, fuller picture. But my understanding is that starting in I think it was the 1970s, 1980s, we did take groundwater samples and we provided those to the state. And if there was an issue that felt that needed to be addressed, we addressed it.
Okay, we can move on to another question in the same theme. Isn't it true that Duke Energy Carolinas also had constructed seeps to channel coal ash wastewater into waters of the state without NPDES permits?
So I believe that was discussed a lot in the last case and was addressed in the last case. Again, Mr. Wells may be able to talk a lot more about seeps. I do know that the company did negotiate a resolution on the seeps through revised SOC permits and NPDES permits, but that would be a better question for Mr. Wells specifically on the seeps.
Understood. And then just one quick follow-up on that, and then I'll discuss with Mr. Wells as well. And are you aware that General Statute 143-215.1 prohibits wastewater discharges into waters of the state without approval under inappropriate permit?
So again, I would state that that's a better question for Mr. Wells. He understands a lot more about the seeps since I know that he addressed it at length in the last case.
And is it still your contention, as you stated in your rebuttal testimony, that the company's operation of its coal ash impoundments was consistent with the law?
Yes.
And that's all I have. I believe my colleague, Ms. Yost, has some questions as well. Thank you.
Good afternoon, Ms. Bednarsek. I've tried to organize my questions such that I'll get a few in before we get to confidential, but I'll certainly signal to you when I think we are going to get into some confidential information. I'd like to begin with some questions about your rebuttal testimony regarding the Phase 2 excavation and transportation of coal ash at the company's Dan River site. Now, the contract for this work was originally awarded by the company to Parsons Environment and Infrastructure Group, Inc. Is that correct?
That is correct.
And Duke set the schedule that Parsons was to follow to complete the excavation at Dan River. Is that right?
Yes, that was a schedule that was included in the contract documents.
All right. I'd like to turn at this point to what was pre-marked as Public Staff 56. The page number on the bottom of the page should be 1597. This is the semi-annual report on closure and excavation, and there's a graph and spreadsheet based on the data contained in that document at the very end. And again, that was Public Staff 56, page 1597. I'll give you a moment to get there. And Chair Mitchell, I would request that this exhibit be marked as Public Staff Bednarsek Rebuttal Cross Exhibit 1.
All right, the document will be marked Public Staff Bednarsek Rebuttal Cross-Examination Exhibit Number 1.
Ms. Bednarsek, have you been able to locate that document?
Sorry, my mute button was not working. Yes, I have it in front of me.
Great. All right, if you could please turn to the last page of that exhibit. And would you agree that on the left side of the page there, there is some data based on planned and actual tons excavated at Dan River. And on the right side, there is a line graph that's titled Dan River Parsons Excavation Tracking.
Yes, I see that.
And would you agree that when we're talking about excavating ash from an impoundment, it's the ash at the top of the impoundment that is excavated first, and then the excavation would proceed down through the layers of ash to the bottom. Is that your understanding?
Yes, you would need to remove the material on top before you move the material on the bottom.
So would you agree that the line that represents the planned cumulative excavation yards, and that's the line that's shown in red, and do you have a color copy?
Yes, I do.
Okay, great. So that's the line shown in red. That it proceeds from June 2017 towards August 2018 on the graph. And then the slope of the line goes up, representing an increase in the rate of excavation. And there's an uptick in that rate around April 2018. Would you agree that that's what's reflected?
Yes, it does show that there is a slight increase or an increase in the slope of the line around April 2018.
Okay. Would you agree, and this could be subject to check, that the red line is based on production rates that are set out in the contract between Duke and Parsons?
So the red line would typically be, what I don't know is as we move forward, we did, of course, have to rebaseline some of our production rates. So what I don't know, as I look at this document in front of me, is if that red line was from the beginning or had been based upon the rebaseline. Just by looking at right now, I can't remember.
Okay. Well, I believe it would be based on the contract, so the beginning point. And Duke, as I think we've established, was involved in formulating those production rates in connection with executing the contract. Is that right?
So we had milestones that we included within the contract.
Okay. And then the blue line represents the actual cumulative excavated yards. And that also goes up over the period that's represented on the graph. But would you agree that the rate does not increase as significantly as the red line?
Yes, looking at it, is that the lines looks pretty consistent after the February 2018 time period.
All right. You indicated, I believe in your direct testimonies, that as excavation progresses down and lower parts of the impoundments are encountered, the ash becomes wetter. Is that generally true?
That is generally true, but there is also, as you are moving on, that the contractor, of course, gains efficiencies as they're working on the site, they're understanding a site and moving forward. So what we typically see that while there may be wetter ash in certain areas, that the contractor is able to address that in order to keep their production up to where it needs to be.
I believe that you actually testified in your direct testimony that, and specific to this instance, the excavation at Dan River, the ash that was encountered lower in the impoundment was actually wetter than had been anticipated, and that this caused delays because additional actions had to be taken to dry that ash out. Is that right?
Yeah, yes, that is true, that it was wetter than had been anticipated, and we were working with the contractor in order to see what are the actions you're going to take in order to dry out, be able to manage this ash so that you can maintain your production rates. And actually in the contract itself, and I'm going off of memory, I could pull it out if it's helpful, but I believe it also does describe what the moisture content of the ash needs to be in order to have proper placement within the landfill. And that was called out in the contract as a requirement. So the contractor knew going into the contract and signing it what the moisture content needed to be in order to properly place the ash in the landfill.
Was it reasonable, though, for Duke to agree to an excavation schedule that called for wetter ash to be excavated at a faster rate when, as you've explained, it's more difficult to excavate wet ash?
So I would go back to say that we had milestones in the contract, and what the rate was is what working with the contractor. And if the contractor did not feel that they could meet that rate, of course, when we go out for bid, we say these are our milestones. And if they have concerns over meeting the contractual obligations within the bid, then they would, of course, be able to say that to us. And that goes in the back and forth before a bid is awarded in order to make sure that if we were to put something in that the contractor did not feel could be met, then they tell us things like that so that we can make sure when we enter into a contract, it is clear what the expectations are and that the contractor believes that they can meet those expectations.
All right, and we'll get into that a little bit later, but unfortunately at this point, I think we are going to hit some confidential information. So I believe this is the appropriate point to leave the WebEx and go to the phone line.
All right, thank you, Ms. Yost. We will leave the WebEx, turn off your cameras and microphones, and those who are under confidentiality agreements with the company may join the line at this time, the teleconference line at this time.
Please turn off your video. Commissioner Hughes, can you please turn off your video? Thank you.
All right, Joanne, just want to make sure you can hear me. Okay. All right, for purposes of the record, we have come out of confidential session. We will be in recess until tomorrow morning at 9 o'clock, at which point we will join the video conference technology. We will go on the record, and then we will immediately go into confidential session to complete the line of questions by the public staff. Miss Force, or Miss Townsend, I'm not sure which one of you will have responsibilities tomorrow with the witness. My notes.
Yeah, it's me.
All right. Okay. Okay. So I'm going to ask this of you, since we will be in confidential session with the public staff. Questions. I would ask that you prepare your questions so that we can go straight into your confidential questions tomorrow and not have to leave the session and then get back into the session if you have questions that will elicit confidential information.
I'm happy to report that I will be not eliciting confidential information.
Okay. All right. And okay. All right. Well, with that, are there any additional procedural questions or issues that I need to address before we go off the record for this afternoon? Anything from Duke?
Nothing from Duke, Chair Mitchell.
Okay. All right. With that, we will go off the record then. We are in recess until 9 o'clock in the morning. Thank you very much.